want to give you a high level on what the itinerary is going to look like, and then I want to make 2 announcements, and then we'll dive into discussion panels. So first of all, this is all about the state of the market. Hopefully you guys set some goals and you have some big ambitions for 2024. The people that I have invited on to this 2-hour discussion, we're going to be here from 10 a.m. to 12 noon Eastern time, are people that I talk to, that I look to for advice and where the market's going and economic indicators and all of those types of things. So these are some of the best in their respective industries. We have, I'll introduce everybody to you as we go along, but we'll be talking heavily about the real estate market specifically and the general economy and financing and the financing markets for the first half. So the first hour of this or so. And we're gonna do 4 30-minute discussion panels. And so the first one's going to be heavily on real estate and the overall economy. 2 is going to be more financing and the financial markets and what that looks like. And then we're going to dive into a couple other ancillary industries, and we're going to be talking a lot about the insurance industry. Obviously, that's gone sideways over the past 2 years. We're going to be talking about tax laws and anything that we need to be paying attention to, anything we might be able to do still for 2023, and things to look out for in 2024. And then a little bit about the labor market for anybody who's looking to build their team or scale what their team looks like. We'll be talking a lot about that. And then I'm going to close down with my good friend Mark Evans. Mark Evans has been a friend and a mentor of mine for a very long time. He always brings a ton of heat, and so he'll close out the final round of discussion panels. We're talking a little bit more about the economy. He's more of a business guy than he is a real estate guy, and get a little bit different of an angle from him just on what his industry does. So super pumped up. We're going to dive right in. 2 announcements. First announcement is this is the first training of our legacy training series. And so every Friday for the month of January, we have some sort of a training that we'll be doing. If you got the registration link, which obviously you did for this, then this would be, then you might have seen the other trainings that are coming up. And we also have, I think, 2 or 3 of them that are lined up for February as well. So we'll make sure that we share it with you. But I want to let you know, every Friday, 10 a.m. to 12 noon, we'll be doing some sort of a training. I know next week is all about acquisitions, off-market deal flow, underwriting commercial real estate assets, and what that looks like. The week after that, we'll be talking a lot about personal branding, social media marketing. I think that's like the 8th wonder of the world if you utilize social media and personal branding the right way. I think it'd be wildly, wildly powerful and could make this your best year yet. The week after that, we're talking about passively investing in real estate, how to source capital, how to find money that maybe you didn't know that you had access to, and what it looks like from a debt investment versus an equity investment versus maybe a hybrid of the two, how to secure yourself, all those kinds of things with passive investments. And then in February, we have a few that are all about, I think there's, what do we do, a team building, right? Myself, my team, we've built a team of, we have over 100 employees if you count our site level employees and staff and maintenance and property managers and leasing, and obviously our investment company, plus multiple other businesses that we own with sizable teams. So we'll be talking a lot about team building, core values, team culture, hiring, firing, best practices, a lot of that stuff in February. And then we have another one in February that's all about operations, all things construction management, property management, asset management for building and scaling your rental portfolio, and a couple more that I can't think of right now. So depending on how these go and how the turnout is, you know, we used to sell a lot of like virtual training stuff, and we're just not doing that anymore. I told the team this year we're giving it all away for free, and so it's leading with as much value as we possibly can here. We have nothing to sell, although I've gotten multiple messages about our mastermind and how do you stay in the community and things like that. So during this, there's nothing to sell. Nobody's gonna be pitching you anything. It's all value. Afterwards, if anybody's interested in learning a little bit about Legacy Family Mastermind, that's our mastermind, I'm happy to hang out for 15, 20 minutes afterwards, share a little bit of information on that from 12 to 12:15-ish, answer any sort of questions, and get to know you a little bit, see if it might be a good fit if you are looking for a community to join. So with that said, let's dive in. So our first panel is with 3 people I have a ton of respect for, great friends of mine and incredible business owners. And so The first is actually my chief marketing officer and director of acquisitions, Nick Burton. He's right here in Charleston, South Carolina, and he has overseen hundreds, or actually thousands of doors and thousands of rental acquisitions that we've acquired. Also here is Mr. Caleb Pearson. Caleb and shoot, we've done at least 10 million bucks worth of deals together. Caleb helped me buy my own primary residence in Charleston. He owns a big brokerage. He helped me buy the island down in outside of Charleston and a couple other properties. One of our very, very good friends, and has a very successful brokerage consistently ranked in the top of all of South Carolina, and also owns several hundred apartments himself, and a very successful flipping, wholesaling, and investment business that does multiple seven figures as well. So Caleb, welcome to you, buddy. And then we also have Mr. Dan Rivers. Dan Rivers also has a management company. He's got the construction side of things lined up, got a big investment side of things, the brokerage, and is one of the most statistically attuned people that I know, especially when it comes to the real estate markets and what's going on both in residential, commercial side of things. So welcome all you guys. And what I want to do is dive in from a standpoint of just high level. Tell me what your feedback is of how you feel about the 2024 real estate market specifically. So Dan Rivers, let's start with you, bro.
Yeah, sure. Thanks for having me on. Super excited, honestly, for the first, at least that 6 to 9 months. The way I'm seeing it is right now, things have kind of like settled in. We've seen the Feds. I mean, let's not talk about the Feds too much. We never know what they're going to do, but we've seen things kind of settle in. We've seen the interest rate come from that 8% at its peak in October down to into the 7s, even touching the 6s here and the end of 2023 and the first part of 2024. It really depends on what happens with the 10-year Treasury bond, what the Feds are going to do as far as, are they going to increase rates again? Are they going to have 3 rate drops? There's a lot of predictions there, but I think we're going to see a lot of similar stats to 2023 as far as things settling in. If there's any stability in the interest rates, whether it's 6.5%, 7%, wherever it is, I think people are going to start to at least feel stable, because it went from 5 to 8 in a matter of 6 to 8 to 9 months. So if things can just stabilize a little bit, and that rate, at least, like I said, stay stable, maybe hits the 6s, I think we're going to see some drastic. The buyers are going to come back into the market, and statistically, usually it's from mid-January to mid-May. You're going to see really where the stats are, how many more buyer applications are out there, how many more buyers are coming into the market, how many more sellers are willing to sell. I think it's something like 85% of mortgages right now are under 5%. So if we hit somewhere close to those lower to mid 6s, we're going to see probably a lot more of those sellers being willing to sell, because that delta is a lot smaller. I'm very bullish, though. I mean, we're buying right now. We're buying a lot of flips, some investment properties to hold. At the end of the day, it's all about the numbers. Does it work? Do the numbers look good? Yeah.
I love that. And what are residential rates at right now for an owner occupant home buyer?
We're in like the low 7s to mid 6s to low 7s. It really just depends on the type of mortgage product. Yeah.
I've been hearing ads on the radio and stuff of saying, hey, we're at the lowest interest rates that we've been at since 12 months ago, right? And so over the past 12, but so I like that, though, because it's changing the narrative, right? Everybody's been so negative about interest rates, and they are lowest, and they didn't even reduce. It's just they said they're not raising rates in December, and that alone reduced the rates on the 10-year Treasury and some of the longer terms. And that gave enough confidence in the market for a lot of buyers to jump back in. Personally, man, I've been getting calls and emails from brokers, from buyers across all my apartment buildings. And there's been a huge step up in excitement of people saying exactly what you said, is like, hey, I was waiting for blood on the streets. I don't really see any blood on the streets. The Fed says they're going to drop rates for the next at least 3 times in 2024. I might as well get my money in play, so that way I can at least make some sort of a yield on it, or some sort of a return, and not, I'm not seeing, or people aren't expecting that drastic fall off that maybe they were thinking about before. Caleb, how about you, bud? What are you seeing?
Yeah, I mean, I think you hit on it. I think the media kind of poisoned the well last year. I mean, it was hot until, like, I would say August, September, and then it just went freezing cold. Like, we had a really tough Q4 on our sales team side, on the brokerage side. I think it was a combination of the time of year, the sticker shock of the rates, like Dan talked about, just going up so fast. And then it was just buyer fatigue. But I mean, we're fortunate enough to where we usually carry between 20 and 40 listings at a time across all different price ranges. So we can kind of see the activity in the market. This last 10 days, it's like the gates have opened up and the buyers are right back into the market. They've changed though. They're not willing to take call it an inferior product anymore. They're a lot pickier than they were 6 to 8 months ago. They're wanting to negotiate more. They're trying to beat sellers up a lot more on repairs. They're getting buy downs paid by sellers. So, I mean, it's definitely put downward pressure on pricing. But I mean, I'm super optimistic about where things are going to go coming up into this year. I think rates are going to get down in call it the low to mid sixes in the middle of the year is what we're hoping. I saw a statistic the other day. The average homeowner in America has $249,000 in equity. That's a lot of money. Yeah, on average, that's a lot of money for people to work with. And I think you're hearing a lot of, I don't want to move. I don't want to get out of my 3% rate. But if you look, I saw a graph the other day as well, where credit card debt and just the average debt for households is going up on an increased slant, on an incline fast. So savings is going down, debt and credit card debt is going up. So I think people are going to start tapping into that, the equity of their homes, whether it's through second mortgages or whether it's through just liquidating and making moves just to kind of get back on a level playing field and erase some of the bad credit card debt.
That's a great point, man. That's a great point. And I like a couple of those things that you said about, I mean, as a seller, I mean, here's the thing. A lot of us on this call are buyers and sellers and investors all at the same time, or maybe just, depends on the season that we're in of the year or the month or whatever. I like some of those things that you said. You talked a little bit about some ideas that buyers are asking for a couple of concessions, and we could do that on the investment side too, right? Buying down points and things along those lines.
Yeah. I mean, it's interesting. The market's definitely changed. But I think it's going to open back up. My guess for the year, or my estimate is, I think we're going to see about a 4 to 5% appreciation in single family homes this year. So nothing drastic like we've seen. I mean, we saw 20 to 30% in some areas of Charleston for 2 years in a row back in 21 and 22. But I think this year we'll see a little bit of an increase.
What was 2023? Did it increase or decrease, or was it like pretty stagnant?
I think it was around 3, Dan. I mean, Dan would know. 3 to 4%.
Yeah, I was going to say there was like 3.6% nationwide was the average increase in values. I actually have it here real quick. The median sales price in 2021 was $370, 22 was $479, and 2023 was $430,000 for the United States. So it's settling in about that $430,000. And in our market, Charleston market, it's about $405. So we run a little bit under the national average. But the other thing too is you have about 1.5 million active listings on the market right now, which is down 7.3% from last year. I mean, numbers like that, builders have been very gradually, building inventory. So it's not like the 08, 09 when you just, had way overbuilt. So between all those factors, interest rates kind of settling in. I agree with Caleb. I could see it in those sixes. It really depends. The 10-year treasury bond going down, or the delta between the 10-year treasury bond and the mortgage rates goes down. You have a lot of factors that could bring it into those sixes. And I think that would definitely open the floodgates. Yeah,
Tim, we still have an inventory problem, especially here in Charleston. I mean, we've got I think it's 2,900 active homes in the market. Last month in December, we saw a drop in inventory of almost 10%. I mean, that's a big drop in 1 month. And I think, and I heard a stat that if every full point that we see as far as an interest rate goes on a mortgage, 5 million new buyers come into the market.
Across the country.
Across the country, 5 million new buyers come into the market. So if we've got an inventory problem and rates drop, I mean, I think the floodgates are going to open right back up. I don't know that we'll see $50,000 to $100,000 over asking this year or anything like that, but I think you're going to see some competition and multiple offers come back a little bit in the middle of the year.
And is there a difference between lower cost housing or kind of mid-level housing or more like luxury type housing? Are you guys seeing anything in that, like a differentiator anywhere in there?
Yeah, it's interesting. It's this, call it 2 million plus range. We haven't seen much of a change at all. And I think it's just because we have so much West Coast and Northeast cash coming into town that price point, they're just not phased by the market shift as much. We've seen the most pressure, Dan, I think in the low price point, in the 350 and under is where we've seen the biggest pressure on pricing. And I think it's just because the payments have gotten to a point to where do people really want to make that monthly payment to live in that type of neighborhood? But above that, I mean, things have been still pretty strong.
Well, like I mean, when you talk about what the average home price is across the United States, $430,000 on basic uh, percentages, right? You need to be making at least 25% of that in order to qualify for a loan for 430. So you need to be making $110,000 a year in household income. That's a lot of money. Like, where are all these people making all this money? Like, where's it all coming from? Like, that's a lot of buyers with a lot of money, it seems like, versus on the lower price point. Like, I could see that, but yeah, I mean, it seems like people are taking on more debt in order to then be able to qualify for these higher price homes. Um,
And that's also I think the median household income is like $76,000. So you're right, you needed a hundred and something
right.
thousand. Yeah.
Like there's a difference. And I feel like something's got to bend somewhere, either longer amortization schedules that lenders have to come up with because of these higher rates in order to keep on writing loans, or prices need to come back down, or the market and the economy has to be stimulated in some capacity, because it just doesn't make sense that there's that much of a delta still, you know?
Yeah, I'm waiting for the 40, 50 year AMs.
Yeah. I mean, that's not uncommon to see in some of the bigger cities. Like I'm pretty sure some of the markets in California and New York have 40-year amortizations for primary residences because it's so expensive. It just kind of draws it out. Imagine having a mortgage for the rest of your life, right? Like,
It would definitely put more gasoline on the market. That's for
oh,
sure.
big time.
Yep.
Big time. Burton, all right, let's pivot. We've talked a lot about the residential side. I'd like to spend the next 12, 15 minutes about the commercial or the investment side of things. So, Burton, I know we haven't been heavy on acquisitions much because we've been stabilizing our own portfolio. We've had to buy out some partners. We've had to kind of sell a couple things and kind of refine our portfolio over the past 12, 18 months. So we haven't been in too much of acquisition mode, but we're still out there. We're still pounding the pavement. We're still looking at deals. Nick, what are you seeing from conversations with sellers, conversations with brokers on the investment side? You know, let's call it 60 days ago versus just in the past couple of weeks.
Sure. You know, the biggest thing is, you know, there are less deals going around. Not that much. I think sellers are just a little bit more hesitant to put out there that they're interested in selling. But because of that, a ton of buyers have gotten out of the game. I've noticed that anybody who
Previously,
like
this is before 60 days ago.
yeah, this is like anybody who is looking at a deal A, B, C, D, multiple different ways is still around. Anybody else who was just kind of a one-trick pony, hey, does it work here? No. Okay, they're pretty much out. I've noticed only the people that are getting creative and know how to structure deals, and other than just 1 + 1 = 2, are still kind of hanging out. So, you know, there's some people who there's really two main people that I guess we would be focusing on right now that I think there are some places to get some deals done. Is one would be people who have loans maturing very, very soon, when they have investors that, hey, the deal was supposed to shape up one way, and now that rates are 6, 7, 8%, they're shaping up a completely different way. And two, another lead that I like a lot is loans that are maturing in like 2029, 2030, because there's a good chance there's assumable debt on it. It's probably at like 3-4%. So, you know, I think people just don't think to look there, I guess. It's just a lot of the loop nets, a lot of the Crexies, a lot of that kind of stuff. And, you know, it's definitely slowed down. I think things are starting to pick back up a little bit. And I think by the end of this year, we'll have evened out a little bit, probably between where we were 2 years ago and where we were this past 6 months or so.
Yeah, I mean, I know from personal experience, right? This isn't statistically drawn, but I got a lot of calls in December for people trying to close on deals by the end of December. I think it's that, you know, they made some money, made a lot of money in the beginning of 2023. Even though things slowed down, they were trying to buy some things, get some depreciation. But I think a lot of these funds realize that with rates coming down, what the Feds announced in December, that rates going to come down even further. They're like, hey, I need to, you know, they raise money and they can make capital calls before the end of the year, and otherwise kind of gets reset, or they have to go and get new commitments after the first of the year. And so I feel like there were a lot of investment funds and things that needed to deploy capital before the end of the year. And there's been many that have been, hey, listen, I don't know if we're gonna be able to close, but let's talk in January. And a lot of those conversations are getting stirred up. I'm getting text messages, emails, and like I said, phone calls on a daily basis from brokers and from buyers directly who are interested in buying our apartment buildings. So it's pretty fascinating to see how much that's picked up in the past 30 days versus what it looked like, you know, 60 days ago, let alone a year ago, you know?
Yeah, things are always a disaster at the end of the year. They're a total
busy.
disaster. People are reaching out trying to get all this stuff done for taxes by the end of the year, and then as soon as January comes around, kind of reality sets in a little bit, and things kind of get back to normal a little bit, and people are like, all right, well, I didn't necessarily park this money right away. Let me restructure this and try to park it now. So, yeah, it's cool. Like things are always, I think, the busiest right at the end of the year and right at the beginning of the year for us.
Agreed. And the exciting part is, like, there's a lot of ambition, right? Like we have over 100 people on this right now, just who registered, right? And not to mention the people watching live, but we have over 100 registered. Like, everybody's ambitious. Everybody wants to know what's going on because they have big goals. They have big ambitions of what's going to happen in 2024. I think that creates an opportunity for, like, we're listing a bunch of properties right now. We've been working on stabilizing some things. I want to list those properties. I think now's a great time to bring those to the market and make them available for people to be able to buy. And as a seller, it allows me to then sell it in Q1, and then I have 9 more months to find another place to place that money before the end of the year, so that way I don't get hit with taxes. I could do a 1031 or whatever, but usually I don't do 1031s. So it creates a big opportunity. I think there's going to be an influx of investment opportunities, right, and deals that come onto the and supply that comes onto the market over the course of the next couple of months here, especially because there's a lot of excitement with being in the beginning of the year, what happens with Feds reducing the rates, and we'll be talking a lot more about financing in the next section here. But you know, overall, I got to believe that nobody wants to rock the boat too much in an election year, right? Like the Biden administration, whether they have direct or indirect influence, they have some sort of influence over monetary policy, and they want to make sure that things look good leading into the election, right? So nobody's going to really rock the boat, I don't think, before the election happens. What does that mean? I think it means we have some level of stability over the course of the next 9 to 10 to 11 months. What happens after that? We don't know, but I think we got a pretty good stable year, kind of to Dan and Caleb's points, of looking forward to that. So, like, if you got things that you got to get off your books, I think now's a great time to do that. If you want to go and buy some things, I think now's also a great time to do that. Dan, one of the things that you told me that I use all the time since you and I sat down on a podcast is, you date the rate, you marry the property. So if you find a good deal in a good area, and yeah, hey, maybe I put 6%, 7% financing on it, you don't have that forever. You might have the property forever, but you've only got that rate for a season of your life. And if you have the ability to then buy a great property and build your investment portfolio and scale your holdings, you could always refinance in 36 months and just kind of bake it into the cost of the overall deal over the next 30 years of ownership. You know, if you have 3 years of a little bit higher of a rate, it's inconsequential almost. It's de minimis in the grand scheme of things, you know? What are you seeing on the investment side, Dan?
Yeah, you also make a good point. You brought up a good point to me. You were talking to someone that's what, 100 millionaire,
That's what a
and they
dude, that's
said,
mastermind, dude. It's two minds coming together, creating ideas, and creates a mastermind. That's the beauty of it. That's Napoleon Hill, right?
yeah, I love it. I love the high level conversations, and I remember you talking about like, hey, we're thinking about the next, people who make $1 billion, thinking about the next 50 to 100 years. If that's the way we're thinking about real estate, not this get rich quick stuff, it's does the property work? As you said, you date the rate, you marry the property. Does the property work? Is it in the area that I want, that it hit all the other criteria? Then from there, I'll take it down. And even if it doesn't cash flow positive or crazy for a few years, I know I'm holding it for the long term. So on the investment side of things, it's absolutely picking up. First of all, I'm seeing more deals hit the MLS that we can make offers on and win offers on for flips. Wholesalers coming out with more deals. I'm seeing more and more. They're still tight, don't get me wrong, but you could find the diamond in the rough from here and there, especially if there's ways to add value to the property for flips. My investors are coming out of the woodworks now, ready to buy again. Hey, let's look for multifamily. Let's look for house hacks. Let's look for those types of things. So on the investment side, it's being creative. Like we just closed a deal the end of the last day of 2023 that had a wraparound mortgage. So it made sense for my seller. We couldn't move it on the regular market, so we got creative there and did a mortgage wrap to be able to move that property. And a month before, we did a four package deal of a sub 2 with a little bit of seller carry. So same thing on the bigger property investment side is you can be creative on the single family 1 to 4 unit as well to make deals work.
Mm-hmm. And we did the exact same thing. We transacted an $85 million deal on December 29th, right? The last business day of the year through an LLC sale, like a membership transfer. And so there are definitely ways that you can move quickly. There's ways that you can creatively structure things where it doesn't jump the property taxes up, right? When something like that happens, when you can take over existing debt, you can take over existing operations. Like there's a lot of good things that can come if you have more tools in your tool belt. And that's the key. The key is understanding, having conversations like this on a regular basis with people who are out there active. What was the stat that you were sharing right before we went live about like realtors and who's actually performing versus who's not performing?
Oh yeah, there was a survey done. Basically, it was 5 areas and about 2,000 realtors. But bottom line, about 49% of realtors did 0 to 1 deals last year, and 70% did 0 to 5 deals. And they were talking about, they think it's more, Pareto's rule, the 80-20. They think it's more than 90 to 95 to 5% of realtors are really doing the majority of transactions. And now more than ever, I think it's important that you're working with people like Caleb, our team that's doing 40, 50, 60 deals. He probably does more than that a year, because there's a lot of different things popping up. You have to have those other tools in your belt to be able to be creative to make some deals work.
Dude, yeah, well, when transactions drop by 30%, I mean, that's 30% less transactions to go around. So the pie just got smaller. So, I mean, that even further pushes that what Dan just said. I think, Tim, one thing that hadn't been brought up that I'm seeing on both the fix and flip side and the multifamily side is liquidity. I'm not seeing people have as much liquidity as they had, call it a year or 2 years ago. So it's almost like you can feel the money drying up a little bit. So I think it's a good time, like you brought up earlier, to buy and to sell. So like to sell the stuff that you don't want and you don't see yourself keeping long-term. But I think there's a little bit of distress in the market on the multifamily side that's coming down the pipe too. I mean, just you and I, we've got plenty of friends that are good operators, some of the best operators around the country that have problem properties that they're writing checks every single month. But so like, when does that dry up? Can they get into better long-term debt? And if they can't, can they get out of the bridge debt? Can they float call it $10,000 to $50,000 a month to float these things while they get these things stabilized? Or can they go raise the capital? I just think there's going to be some of those deals that catch on fire and get thrown out to the market here mid-year.
I agree. All right, closing thoughts before we move on to the next panel. Burton, give me a big exciting takeaway or what you're looking forward to in 2024.
Yeah, man. I mean, the biggest thing is just I mean, our ops team is going crazy. They're crushing it. They're absolutely crushing it, and I'm excited for things to really kind of take shape and finish up so we can get right back in buy mode. You know, I really do feel that if you can get creative on deals and structure it a little bit differently, I think you can absolutely crush. You know, we used to put out offers in 2020, 2021 with seller financing, and we really didn't get much of a bite. It was, I would say it was probably at least 90% no's. And now with interest rates and kind of the buyer pool drying up a little bit, I would say it's almost standard now that we get some kind of response or some kind of counter. I would say well over 50% of the offers that we make are somewhat open to it in some degree. It's just, hey, I know I'm going to shoot for the moon on my first offer, and we're probably going to meet somewhere in the middle. So, you know, making a couple offers, understanding the blended cost of capital is the key to this, and just keep making offers. You know, there's a lot of people that say they want a deal. There's not that many people that make offers on deals. So making offers and getting creative with those offers, I think you can absolutely crush.
I love that. And we'll be talking a lot about that next week on the acquisitions and underwriting side of things, blended cost of capital and all that stuff. So if you guys are not registered for that, jump on next week. Again, another free training, 10 to 12 next Friday. Dan Rivers, give me a takeaway or something that people can look forward to in 2024.
Well, I think one of the biggest things is the media stopped listening to a majority of them. You know, they had this big dumpster fire for 2023 and it never really happened. Unemployment stayed well. Rates did go up, but the market didn't crash like everybody thought was coming down. So what do they say? You know, run towards the fire, not because everybody else is running away from the fire. That's my biggest thing for 2024 is if you're sitting on the sidelines ready to go at it, or if you're already in the game, stay in the game. As Nick mentioned, a lot of the investors are getting scared. They may make one or two offers and get out of the game. We're all systems go. I'm bringing on a head of acquisitions in about 3 weeks. You know, 8s, 9s, 10 players. You know, come and stay in our lanes and let's really grow this year. So I think 2024 could be a growth year if you're willing to go for it. You know, stay the course. Make sure you know asymmetry. You know, high reward, low risk. Make sure you know your analyze your numbers, know your numbers. But I'm excited for just taking advantage of everybody going the opposite direction and blowing up in 2024.
Love it, man. I agree 100%. Caleb.
I think on the residential side, I think we'll see rates go down. I think we'll see inventory start to go down, and I think we will see prices go up a little bit. Not anything too drastic, but I think it's gonna be a good year on the residential side. And then on the multifamily side, I think it's gonna be a year where you can pick up some pretty decent deals.
I agree. I think there's going to be some. I think just the past 18 months, right? Really, 12 months, 6 months, has kind of like gotten the newbies out or gotten the people who weren't very strong out. It's kind of thinned the herd, if you will. But I think you got a lot more serious players, right? So I think the conversations are more serious. I don't think there's many tire kickers that are going to be out there. I think if you have the conversation with somebody looking to buy a deal or sell a deal, I think you're talking with a more serious person than maybe 12 months ago. And I do believe that there's going to be some serious action. I got a lot of optimism for 2024.
Same.
So awesome. I appreciate you guys. Got so much love and respect for you guys. Thank you so much for being here. And with that being said, I'm excited to see what you guys do over the next 12 months. And we are going to pivot now to our next section. Our next section is all about money. It's all about financing. It's about traditional financing. And we have 3 panelists who are, again, dear friends of mine, people I've done a lot of business with, millions and millions of dollars, hundreds of millions of dollars with some of them. And they understand the commercial financing world. They understand the residential financing world, both short-term financing and long-term financing. They have their finger on the pulse of things. So let me introduce, first of all, Mr. Chris Litzler. Chris Litzler's with Marcus & Millichap. He has been my commercial mortgage broker for, going on like 10 years now, I think. And I run everything through Chris. Like, even if the seller says I got to use another broker, no, I'm looping in Litzler. I'll pay him privately because I trust this guy and he knows his stuff so much. They have him speaking on national stages. He's brokered over $1 billion of real estate loans over the past handful of years, and just him and his team personally, internally. And so really understands the commercial side of things, does larger loans with agencies, that's Fannie, Freddie, HUD loans, life insurance companies, and then obviously debt funds, local banks, all those things. So Chris Litzler, excited to have you here, brother. Thank you for being here.
Yeah, guys, thanks for having me.
For sure. And then I have Miss Kelli Garrett here. And Kelli is a fund manager. She actually has flipped businesses in the past, made some money, then would passively invest it into real estate. Rolled into more of a hard money lending business. And now her company, Rehab Wallet, did over $100 million of loans last year, right? And they're going to do about $150 million in loans this year. So they have their finger on the pulse of things more on a regional basis, but they go some other places with some of their lenders. But they do so much volume, so much transaction. They're very active in raising money. They're very active in deploying money, and very, very successful in what they do. So Kelli, welcome to you.
Thanks, Tim. Thanks for having me.
And Whit McCarthy has built up a large investment fund that did a lot of residential loans, a lot of both short-term and long-term loans. That company got bought out a few years ago and created an opportunity for Whit to kind of move over and essentially do it again, right? Do it again on his own and do his own thing and build up a company called Consistent Capital, which he launched last year in 2023. And I would say, I mean, Whit, you could probably answer this better than I can, but it's more smaller or up to 10 units loans, both short term and longer term. It essentially, he works closely, and I think Kelli's a partner in your business, but you guys work closely together in Kelli will do the short term loans for under 12 months. Whit then puts debt in place for over 12 months on mostly investment side of things. So this is like, no matter what size deal you're doing for everybody who's watching, there's somebody here in this discussion list who can help you get money to do more deals. All right. And I get nothing for saying that other than having amazing people in my community and in our tribe and just being able to add more value. So make sure that you connect with each of these guys. And Whit, thank you for being here, brother.
Yeah, appreciate it.
So let's get rolling. And I want to know exactly what interest rates are going to do in 2024. So I'm going to start with Chris Litzler. I want you to tell me exactly what my rate and when I should refinance all my properties.
Yeah, I can't tell you what it's going to do, but I will tell you where they're at right now, where they've been, and then give you some kind of data on what would impact it going forward.
Let's do it.
So there's two key things going on. You have inflation that's too high, and part of a result of that is you have employment that's very low and very strong. So if you have inflation at most recent data is 3.1%. That's well above the 2% target that the Fed wants, and you have an unemployment rate of 3.7%, which is incredibly tight. So as a result of that, you have the Fed that controls the short end, the overnight borrowing rate, the federal funds rate, at a very restrictive level. It's at 5.25 to 550 range. 530 is the Fed funds rate today, SOFR. So that's a very short end of the curve, right? That's daily borrowing. And those rates are for construction loans or short-term loans, right? You always want to think the lender wants to match their assets to their liabilities. So a bank who has deposits, right? They have short-term liabilities. They want to make short-term loans. So you price with a spread, two components of an interest rate. You got the spread and you got the index. So you got an index of 530 and you have some spread, right? So that's what construction loans would price at, or short-term floating rate loans. And then subsequently, you have the longer end of the curve, which is more set by supply and demand and longer macroeconomic trends. The 10-year Treasury today is like 4.05%. It got up to 4.10. I don't know if it came back a little bit, and that's because you had a really strong jobs print. At the end of last year, just a measly 1 week ago, you had a ton of optimism. You had 10-year UST at like 375, 380, coming way down very fast, a lot of optimism. And this week has been the total opposite. You had a big run up in rates because the economy is clearly more resilient than what some of this Fed talk had been signaling. So I don't know where rates are going to go, but if you say long term, 10-year fixed rate loan today, probably in that high fives, low six range, little adder for some flexibility in the prepayment.
Even with, so two questions here. Do you think that excitement of going from 375 up to 405, 410, where we are today, just in the past week or so, do you think that's because there's more demand of people looking now in order to do more loans and more investors coming out of the woodwork after the first of the year? Is that something that's pretty typical in early January?
It would actually be the opposite, because the long end of the curve is set by supply and demand. So if there is less demand for the paper, the yield would go up. So it's actually been less of that. So the theory was, Fed comes out, Jerome Powell 2 weeks ago says, we're planning to cut before we hit the 2% inflation target. So you kind of had some talk saying that they were going to cut rates. Like there's 6 rate cuts priced in, which probably has moved already today. Even though the Fed was saying there's only going to be 3 down to 4. Yeah.
We're sub 4. We're 3.957 right now. So
yeah, versus
I have a
6
3 handle on it.
versus 6 last week, right? So it's that sort of talk that is moving the long end of the curve.
So now they're saying we're going to get potentially up to 6 rate cuts. Now, at best, 4 is what's being indicated right now. And that has lowered the confidence of lenders and the long-term rates.
Yeah, and that's a as soon as this week thing, last several days thing. This is it moves very quickly.
Interesting. When is the next meeting of the Feds in order to talk about rates?
End of January, right?
Yeah, it's at the end of every month, I think, right?
CPI comes out
a couple days ago, and there were notes made to the media, which obviously throws things into a spin. One of the comments made by one of the Fed representatives was "buckle up," right? And buckle up, not necessarily in a good way, which led to a sharp little increase on that 10-year for just a short period. And now we're, I think, seeing a little bit of easing on that. With see the 10-year back in the threes. Sure, it's at 3.962, but having a 3 handle on it is a whole lot nicer than what it was, looking back, 9-10 months ago when we were, in the 5s.
Yeah. And so how do you stay level headed on when am I going to put long-term financing in place? Like how do I try to time this?
You can't. I mean, no one has a crystal ball, and I think everything is, especially this year being, the volatility going into an election year. I think it's really hard to say. I think you guys said it well before. Like you're dating your current rate, right? And so I encourage people. I still think based on the supply issue, right? If you are able to find deals in this marketplace and you're able to make them work with solid economics and solid fundamentals without stretching, I would encourage people to get into and buy as many properties as they can. I'm doing that myself. I think it's harder to find those deals because there's so much locked up inventory because people are not trading out of their 2, 3, 4% mortgages. But if you are able to find those deals and you're in line with the wholesaling community and can find them, I would encourage buying because one of 2 things are going to happen, right? Rates are going to go up or rates are going to go down. In the case that rates go up, it's limiting the buyer pool. More people get priced out of the marketplace. Those people still need a place to live and will remain renters, right? Which provides a great opportunity for people aggregating rental properties. And I'm mostly speaking from a residential standpoint right now, really kind of the 1 to 4 units. I'll let Litzler speak to the bigger stuff, but as those rates go up, more people get priced out, more people continue to rent. And I think that leads to more renters in the marketplace, rent increases. So I think that's a positive. And then in the cases where rates go down, you're going to see a whole lot more buyers come into the marketplace. So like you said, Tim, I think every 5 million, for every 1 point decrease to interest rates for the standard kind of conventional borrower, there's 5 million more entrants into the marketplace. And that's a stat from Barry Habib, a big mortgage guy. And with that, obviously there's a lot more buyers, a lot more people can get into these properties, which means there's a lot more people chasing the inventory, which means you're driving prices up. And so if you're holding those properties, you're able to get into those deals today with the solid economics and fundamentals and ensure that you're not getting in a deal for a cash flow negative position, then I like both sides of that coin from the investor standpoint right now. So I'm still super bullish on what's going on inside of the residential investment world.
I agree, man. I think having a long-term mindset as opposed to getting shaken up of what's happening this week on any of this stuff. If you like, my dad just looks at like the market every single day of it going up and down. He gets like all stressed. I'm like, Dad, who cares, right? Like let's look at what happens over the course of a year or 3 years or 5 years or longer. And that is a better way to make decisions, right? The most successful people that I know make decisions on a longer timeline, thinking about something on a longer timeline. And that way they don't ride this emotional roller coaster of too high when things are good, too low when things are bad. It's just, dude, they keep the bar down on the roller coaster and then they have a long-term vision. And that keeps them level-headed and again, helps them make better decisions. So
our rates
Kelli,
are obviously directly tied to the marketplace. And I will say, like, over the past 60 days, we've seen a drastic improvement in rates. I think based on kind of DSCR requirements, we're seeing more deals pencil. So it's a good time right now, right? We're able to start, quoting deals out and on the residential side and the, low to mid sevens again for, a non-max LTV, which is great. And I envision, rates continue to drop. In the near term, I can't speak to anything really beyond the next 30 days though.
Yeah, well, I think if you look at any economic stock market, it goes up and down. Interest rates, they go up and down, right? Supply and demand goes up and down in everything that you do. And so if you realize that it always goes up and down, yeah, hey, you're maybe not as happy this week as you were last week with rates, but what are you comparing it to? If you're comparing this week to 90 days ago, you're really happy. You're much happier than you were. Like there's a construction project that we have right now. We were supposed to refinance about 60 days ago. We didn't. A couple of the certificates of occupancy got delayed by about 90 days. And I was like, thank God they did, because it dropped my rate by an entire point, right? And it gives me an extra $10,000 a month of cash flow on this thing because of that. And so, I don't know, maybe it's $8,000 an extra cash flow today than it was last week. But at the end of the day, man, I'm winning in a big way. So what are you comparing it to? I think that's an important takeaway from this.
And at least for the single family aggregators of rental properties, even if the rate was 8.5 and now we're able to put it at 7.5, the incremental difference, if you're buying a kind of at least in the Southeast, a residential asset for cash flow purposes, call it $175,000 loan amount, the incremental difference between that 1% rate on a 30-year term is we're talking like $60 a month, $70 a month. Like, it's not a massive swing, but
and it's not for 30 years, right? It's for 3 to 5 years until you refinance again.
Exactly. Right.
Yeah. So Kelli.
Yeah, that kind of takes me into the short-term stuff. Like when people get really hung up on this rate,
right?
And we're in it for 6 to 9 months, and you're budgeting 1% or 1.06 a month. What's the big deal? Like, let's not get hung up on that rate. Let's just get in the project, use a lender that can definitely show up with the money. Close it fast, because that's 100%. That's what we're all about, right? You're going to come to me not for the we're not the cheapest in town, but you're going to come to me for getting it closed and getting it closed on time. If you need a 48-hour close or a week close or a done alone in 12 hours, that's not typical, but that's why you're coming to Rehab Wallet, right? We're not going to talk a lot about rate. It shouldn't concern you because you're going to be in this loan so short, right? The boys over here on the screen here, that's where we concern ourselves with rate if we're going to keep it for 30 years. But just like Whit said, let's not get too consumed with it, especially when the loan amount is so small. When you talk about your $85 million loan, now 25 basis points means a lot.
It does mean a lot.
But on a $150,000 loan, it doesn't.
And it depends on the timeline, right? On a $55 million loan that you have out there for 3 years, it definitely starts accumulating, right? But if you're a great flipper or you're going to turn this thing around, there's a lot of ways to price that into the cost. Just like you're going to put a new roof on the property. Well, guess what? the cost of capital should be included if you're underwriting the deal the right way. And understanding that these rates going up just means that you need to negotiate maybe a little bit lower price on the purchase side, or need to figure out a way to reduce the taxes or reduce the insurance or find another way to cut costs somewhere else if this is a variable that you're not able to influence, right? And so it's part of doing business. It's just things ebb and flow all the time. And when you think about the grand scheme of things, if I could take this deal down and I know this is going to be a good deal long term, who cares what the rate is? What have you seen, Kelli, as far as like how has it affected your borrowers or your volume? I think you kind of answered the question that they're looking more at the long term. They're looking more at the opportunity in the obstacle, not the obstacle in the opportunity, right? Like the amount of competition has decreased, and so they're able to go in, still buy deals, still renovate deals, still sell deals, and have great exits on these things, as opposed to getting hung up of the rate went from 12% with my hard money lender to 14% with my hard money lender, and I'm not going to pay that. Are you going to walk away from a $50,000 profit on the flip, or what are you guys seeing on that front?
Well, obviously in 2023, it's for us, it's a balancing act of our fund on how much money we can raise with capital. Then we can go out and loan it out. Obviously, we raise it a certain percent, pay our investors upwards of 8%, compounding it upwards of 10%. And then we'll go over here and loan it out 13, 14% and a few points, right? That delta is our business plan. And that's what makes Rehab Wallet and most hard money lenders. So, we've seen definitely an uptick in loans, 23 over 22. You've been in business now 3.5 years. Every year seen an uptick, work hard on getting the business coming to us, but we have to work even harder on raising the capital. And that's been in 2023, we changed the rate. We were only paying out 6%. It sounds crazy that we raised over $100 million at 6%, like $100,000 at a time. But then in April, we changed it to paying out to our investors 8%. So when I did that, I had to raise the other side of the debt instrument, which happens to be lending. I had to raise that side up from 12 to 13 and some change. And so raising the capital has gotten a little bit tighter and a little bit harder. We're adding some people there on our org chart to keep it in line with the supply that we have over here on the lending side. So the supply on the lending side is there. Now we're over here having to raise the capital. And then we got to do it every day. And it's an open fund, and you continue to lend and you continue to raise every single day. And yeah, our goal this year is it's actually 125 million. It's not 150 million. We're gonna have a 25% increase. We're gonna, we just have to stay in balance with the capital that comes in.
Mm-hmm. Yeah, and that's the name of this game, right? How do you balance deal flow with money flow? Usually, you're either heavy with one or heavy with the other, but
exactly.
Very rarely are you balanced out. And do you have the exact amount of money flow as you need for deal flow? Mm-hmm. It's a balancing act, which is why you need to have people doing, and all of us need to be doing both of those all the time, no matter what. I remember having these feast or famine cycles early in my real estate career when I'd be flipping houses and I'd have so much deal flow. I'd like turn off the marketing machine. Let's finish operating these deals. And then when we go to sell them, there's no deals in the pipeline anymore. What happened? Well, you turned off the marketing machine. You need to be raising money and sourcing deals at all times, all the time, which is a great takeaway for everybody who's listening here. And Kelli has specific people to be consistent in each one of those different activities to ensure that her business has consistent deal flow and consistent money flow. So that's awesome. One of the things I wrote down here at Litzler is how do I recap? All right, so let's say I'm going out and I'm looking for a deal. How do I recapitalize, or how do I figure out, maybe I want to buy a deal for $15 million. The seller has a $7.5 million loan on it, and it's at 3%, and it's assumable. But I'm only at 50% loan to value. What are some ideas and strategies in order to kind of take over that assumable debt and then recap it and add a little bit of extra cushion so I don't have to go and raise $7.5 million? You're on mute.
Cool. So the first thing you want to think about is a marginal cost of capital. So if we have a $15 million purchase and we're assuming a $7.5 million loan, so that's 50%. So 50% of your stack is at 3%, but you're bringing equity for the remaining 50, right? So what's the cost of that equity?
What's the
14,
cost of it and
16.
how much work does it take?
Correct.
Right? Because if
How-
I'm buying a $15 million deal, I could go buy two $15 million deals if I had $7.5 million, right? So there's two, one, it's going to cost me 10% preferred return minimum with my investors. But secondarily, I only get into half of a deal. And so talk about both of those.
Yeah. So I mean, look, so if you raise half at 10 and half at 3, right, your blended cost is 6.5,
Mhm.
right? Or I could do 80 at 575 today, right? With fresh debt, right? So you're weighing the marginal cost of proceeds is the first way to think about it. So that's the first thing. The next thing is, practically speaking, how could you even go about doing that, right? So if you assume this loan at 7.5%, is there even an ability to add supplemental financing or a second mortgage to it to leave that first tranche in place? It may be an option, it may not. For example, if that 7.5 million is with a life insurance company, there's no supplemental financing available, right? So that's just, that loan is what it is. So the reason we saw a lot of these assumptions taking place is because there was big prepayment penalties on that $7.5 million balance. But today, with a 3.5% rate, it would just be a 1% penalty. So it may not, that seller may not be so focused on making you assume the loan. So you got to look at your marginal cost of capital. You got to look at, could you even assume this thing, and what are your ability to add supplemental or secondary debt to it in the existing loan documents?
I think that all great points. So first, calculate your blended cost of capital, see what it looks like in order to assume it and raise new money and whatever that looks like versus just finding new debt. And you can actually potentially, even with the increased interest rates, be in a better position because you can have a higher loan to value. And then secondarily, you said if it's a type of loan like a Fannie Mae loan, for instance, you can add supplemental debt. Some HUD loans, you can add supplemental debt. And that way you keep the existing debt in place at whatever rate it's at, and then you could just kind of top it off. And the only interest rate increase is on this secondary mortgage, essentially. It's what supplemental debt is. It's a second mortgage in the grand scheme of things. And then thirdly is people didn't want to pay off their loans before because there's something called yield maintenance. Yield maintenance means if a lender gives you a loan for 10 years and they expect to make 3% over the next 10 years, and you only own it for 2 years and then you sell it, you're going to have to pay whatever interest they thought they were going to get over the next 8 years. But it's not exactly that. It's actually the difference of what they would
difference
take
in what they could reinvest the money in treasuries for, the corresponding treasuries.
Right. Now the treasury went up to 5%. And so if the treasury goes up to 5%, they can actually make more money if you pay them off, and they'd be fine with that. So they lower the prepayment penalty to nothing. So this leads me to the next question, Chris. What do we need to be paying attention to today if we put new long-term permanent financing in place, right? What loan terms with a lender? Specifically, I'm talking about the prepayment penalties.
Sure. So the best available interest rate in today's market, and pretty much any market, is going to be a very stringent prepayment penalty called yield maintenance, right? That's the best possible pricing. And because all of the loans today are constrained by coverage, right? I'm not really constrained by value today. I'm constrained by coverage. The lower the interest rate,
meaning
the more
debt service coverage is what he's talking about,
yeah,
right? So making
yes,
sure that you can pay the loan plus usually it's a 1.2 or 1.25% debt service coverage ratio. That means all the net operating income that comes in after operating expenses is at least 1.25%, 1.25 times whatever your debt mortgage payment is.
That's right. So the lower the payment, right? The lower the mortgage payment, the more loan proceeds this property will qualify for. So you're making a trade-off. Would you rather have more flexibility in the prepayment penalty, but pay a higher rate and qualify for less proceeds? Those are the two things you're weighing. So the way to
give me those one more time.
Cool. Lowest possible interest rate but a potentially stringent prepayment penalty gets you the most possible proceeds.
The highest loan to value.
Highest loan amount, right? Or pay a premium in the interest rate to get a more flexible prepayment penalty, but likely qualify for less loan proceeds today.
Mm-hmm.
So the question is, what's your business plan, right? If this is 100% your deal, your money, right? And you can return all of your equity. You can plan to hold this thing forever. You may say, let me get all the proceeds and, I'll just move on with my life. Or if we're trying to return, if it's, a typical syndication, we can only return 80% of the equity, and we're probably going to want to recap this thing again, then we may take a little bit less proceeds today and have the flexibility to recap it again.
Love it. Whit, what are you seeing as far as how lenders feel about the market?
Mm-hmm. And
meaning how is their confidence level? Are you seeing that a lot of lenders in the residential space, debt funds and banks and institutions and everything else, they want to put money on the streets? Like how are they reacting, responding when you guys are taking deals to them in order to capitalize?
Yeah, so we are a gain on sale model, which is very different from what Kelli and the rehab wallet team does. Meaning we originate our loans, hold them for a short period of time, and then sell them into the secondary market. Right? Chris operates in a similar capacity in the way that loans kind of transact, and all loans are originated and sold. In those loans, I can tell you there is still an amazing appetite for this type of paper. And when I say this type of paper, it's business purpose loans. And again, I'll speak more to the residential side, 1 to 4 or possibly up to 10 units, but a very large appetite for this alternative asset class, which is still compared to a lot of mortgage-backed securities, is still very much in its infancy. And there's more people coming into it, trying to get an understanding of how to operate it. So it delivers a typically higher yield than a standard mortgage-backed security, but I think has a very appetizing risk profile to these investors. As far as leverages, these aren't 3.5% down FHA loans. These are at very minimum, typically 20% down on acquisition, and then a larger equity positions, at least 25% equity positions on cash out refinances or rate and terms. So it's a strong appetite in the secondary market. And I don't see that diminishing at all. We are tied to the markets as far as like the 10-year, and our rates are moving almost on a daily basis. It tied to all the different things going on in the economy. So things are moving, and like I said, I think rates have improved drastically over the past 60 days, and I think it's a good time to get in. But I did see, Tim, there was a question in the comments from Franz about prepayment penalties, kind of on the back of what Chris was saying, and he mentioned a 5-4-3-2-1 step down, right? So a 5-4-3-2-1 prepayment penalty, different than the yield maintenance type of prepays you'll see in more CRE products. The 5-4-3-2-1 means that it's a 5-year prepay. If you want to pay off that loan in the first year, it's going to be 5% penalty. So if you have a $100,000 loan, it's going to be a $5,000 prepayment penalty to pay off that loan in the first year. Second year, it's going to be $4,000. Third year is going to be $3,000, and so on. The question was, what are your thoughts on getting a lower interest rate with a 5-4-3-2-1 prepayment penalty versus a higher interest rate with no prepay? I think there is a happy medium there. I have the opportunity and with our clients to quote out a 5-4-3-2-1 step down on deals. I don't in almost all cases, because I don't think it's a wise prepay to get into. I think a 3-2-1 or even a possibly, depending on your investment horizon for that deal, a 2-1 step down are doable. I wouldn't chase the lower interest rate, and we're talking anywhere between 20 and 30 basis points. I would get yourself into a 3-2-1 is, I would say, more the standard for the residential space. So you don't lock yourself into a longer period of time, because if rates do drop significantly in the next year or 2 years, you're caught and you've got a significant penalty to pay if you do want to refi or sell that asset. So I think there's a happy medium. No prepay on long-term debt is expensive. It's very expensive. I wouldn't encourage that. I think that 3-2-1 is a good happy medium in there, because worst case scenario, if you want to sell in 2 years, after 2 years, it's 1% of your UPB, right? And hopefully appreciation on that asset will, fully cover that and more.
Love it. I love it. Good insights, guys. All right. So what I'm going to ask you to do is give a key takeaway, a key thing to look for in 2024, or a piece of advice as everybody goes into the new year from a financing, business, real estate perspective. Kelli, I'd love to start with you.
Definitely going in optimistic, but I also have been on the block for a lot of years and know still have a little PTSD from 08, 09, 2010. So I'm going to be a little conservative. I'm staying conservative. I'm staying conservative on our after repair values to lend out. I'm still definitely watching the market on a daily basis because we just don't know. Selection year is always wonky. I'm not over the top optimistic, but I'm also not the Debbie Downer as well. I definitely say get in the game, whatever it takes to get in the game. If you're starting your real estate career or you're in your 6,000 unit, doesn't matter. Just stay in the game. Work with some people that know what they're doing. Work with some people that have been around the block a few times. Obviously, you heard these two men speak, and you could tell they're very, very smart and very capable of what they're doing on a daily basis. On my side, one of the questions was, what kind of deals do we lend on? We're lending on their fix and flip, single family, up to small multifamily. Probably the biggest loan we have done is maybe 3 million. But we don't even like to stay there. That's very, very it's abnormal. Our average loan amount is sub 250K, and our average investor is that $350,000 ARV. So we're in and out 6-9 months. Go at it, keep buying, but just keep your eyes open in 2024.
I mean, so many good takeaways of just like, get in it and stay in it, right? Whoever has the staying, like the starting power is easy, especially at the beginning of the year. People are starting to work out again. People are starting to eat healthy again. People are starting a new business or new industry or new whatever. Like, it's not the starting power that people lack. It's the staying power. How much staying power do you have to ride this out? Because it will get easier, right? There's things that are easier. There's times that are harder. There's times that are in the middle. And to me, real estate is not an experiment. It's something that has built massive amounts of wealth or help people retain their wealth in some capacity. They either make money in real estate or they conserve their wealth in real estate. And so it's a good game to be in. And
I keep this little phrase, and it says that recessions are painful, but the expansion phase are powerful. So if we can get in the deals and stay in it, even if we have a recession, recessions are very short-lived. I think the average recession was like 14 months, but the average expansion phase was like 47 months. So, be able to stay in it, not give up, not have to get out, because whether we go into recession, I'm not gonna call it that we are, but just be able to deal with the phase, because it's short-lived. This too shall end when and if we were to get in it, because once we get into the expansion phase and you're staying in the game, that's when powerful, and that's when a lot of the money's made.
Yep. Do good deals and operate well. That is a controllable that you have control over, right? There's a lot of other external components that we don't have control over. What can you control? It's doing good deals and operating well. That's the key. Whit, how about you, buddy?
I mean, Kelli said it. Like, I think if you're not in it, get in it. And if you're in it, stay in it. Because I think we will see kind of the fruits of the labor as we kind of work ourselves through 2024. Again, hard to say what's going to happen with rates, but I think as long as you're buying and or operating with solid fundamentals, we're all going to end this year in a very, very strong position. So I would tell you that if your business is a little slow right now, if you're not finding the deals, continue to chase them, but at the same time, with that extra energy that you're not deploying towards acquiring more assets or whatever it may be, focus on your systems, focus on your processes, focus on the things that can help build your business with a solid foundation, right? Really hard to build a foundation underneath the house once the house is built, right? So make sure you're doing what you need to do today to set yourself for success going forward.
Love it, man. Litzler, bring us home, buddy.
Yeah, I think we're just telling folks not to try to time the market, right? As soon as your property is you complete your business plan, it's time to put permanent financing on it and move on to the next one, right?
Agreed.
You finance a deal at the absolute lowest possible point, right? And that was a great deal for you, but we didn't really know it at the time. It could have gone lower, right? So you never really know it's a great rate until 6 months later. So don't try to time the market. It's a long career. You're gonna have some ups and downs, but just keep doing good deals.
Love it, man. I love it. And by the way, guys, if you're not following everybody, you're not connected with everybody. Like the reason why we've had so much success is because I surround myself with these kinds of rock stars, and I have these kinds of conversations on a regular basis. So if you're not following these folks, you need to be. Make sure you're connected with Kelly and Whit and Chris on social media, and Dan Rivers and Caleb Pearson, and everybody else that we're going to be bringing on. So connect with them, do business with them, and really take in the insights, because these are people operating at a very, very high level. So appreciate you guys. Thank you so much for giving us some insights on the financing side of things. We are going to pivot now into more, I guess, kind of like the operations and a couple other industries. So appreciate you all. Thank you so much for being here. And as we moving to the next section, we're going to be talking a lot about insurance, taxes, and the labor market. So the first person I'd love to introduce is Mr. Scott Hanis. Scott Hanis worked for a $2 billion investment fund and hedge fund that would go out and buy businesses. And Scott was in charge of all the human resources side of things. And so he had over 950 employees that reported to him, and would help put the right people and personnel and manage that personnel the right way as he continued to grow, and they'd acquire new businesses. He left that company a few years ago after attending a mastermind, and started his own business called Fortitude HR Solutions, which helps business owners on a couple different ways. They work on a retainer in order to kind of like be their fractional human resources department. They help put people in place if you need staffing or assistance in that side of things. And we utilize Scott in 3 different companies of mine. I have him on retainer because he brings so much value. And if you're looking to scale your business from 7 to 8 figures and beyond, he's a phenomenal resource for you at a very reasonable price point. I've been telling him to increase his rates and his prices, but he won't do it. So now's the time to connect with Scott. But appreciate you being here, brother. Thank you.
Thank you so much, Tim. Thanks everybody for attending today. Appreciate you.
Yeah, man. And then I think Melanie Sikma is here from the tax side of things, and Melanie and her business partner Byron McBroom are tax experts. They have a company called One Stop Tax Strategies, and they think outside the box on a lot of stuff, right? Like a lot of people take their financial statements to their CPA. Their CPA just files them. Like these guys take them, they analyze them, they figure out where they can increase income, where they can decrease expenses, where they can add some margin, where they can get creative on reducing their tax liabilities, and doing it in a very, very, it's obviously everything's above board. And at the same time, it's like, how do we multiply your wealth? Because your tax liability is always going to be your biggest expense that you pay over the course of your life. And so I've had multiple calls with them. They're part of Legacy Family Mastermind and absolute rock stars. So Melanie, welcome. I'm excited to have you here.
Thank you. Excited to be here.
And then I think Drew Maconachy. Drew Maconachy is our commercial insurance agent, and he insures all of our properties, thousands of doors for me, thousands of doors for people in Legacy Family Mastermind, and many, many other businesses. And he's different than a lot of other insurance agents. He comes in and comes in with an informational, educational approach of like, hey, listen, I can get you the lowest coverage. Here's what that coverage is, right? Versus or the lowest cost of coverage, but here's what you're going to get. You might as well just light this policy on fire because it's not that good, right? Or you go with this one, it's marginally more, but you get so much additional coverage. And he does a phenomenal job at that. And I have my personal stuff with him. I have my commercial stuff with him. He's an absolute all-star at what he does. He owns Maconachy Stradley Insurance Agency, and they can do stuff all over the country. So, Drew, welcome, bro.
Hey, thanks, Tim. Looking forward to to hearing what everybody else has to say and giving my piece of mind too. So
I love it. I love it. So I wrote down some questions, and I'm going to get started with Melanie. Ladies first. Tell me twofold question. Is there anything that we can do to lower our tax burden still for 2023? So that's the first question. Second thing is, what do we need to be paying attention to for 2024? What tax laws, what changes are coming? What are the things that we need to be aware of and plan and prepare for?
Yeah, so to the first question, there's not a ton you can do. The most bulk of the planning needs to happen before the end of the year. Some things you still can do, though. You can still do cost segregation studies on properties that were in place in 2023. But I would just get started on that now if you're going to do that. And then one thing you can really do is just scan your bank accounts, scan your books, and scan all your transactions, and scan your personal accounts for maybe some missed deductions. A lot of the times you might use a personal card and kind of miss not putting that in the business. But some expenses, a trip you took, maybe some car insurance, home expenses that can be put like on the home office, some meals, car, gas, all that stuff can really end up saving you a lot. So that's one thing you can do.
It's so simple. It's so simple, yet I bet a lot of people don't do that, right?
Yeah,
And that's such a good, easy strategy. And then to your other point, I just want to make sure that people realize, hey, you might have messed up in 2023 and you didn't have these conversations earlier. Make sure you have a great CPA and you plan accordingly in 2024. As you heard for the past hour, people are pretty optimistic of what the market's going to look like. Make sure you have a proactive CPA, right? Like Melanie and Byron. And if you don't, talk with them. And again, I get nothing from saying this, guys. I want to support great people, because these are people that I utilize in getting insights and feedback and all those things from as well, because they're so good at what they do. I've already been through all the bad CPAs. I've been through the bad insurance agents. I've gone through the bad ones in order to find some of the best in the entire country. So utilize them as resources.
Yeah, for sure. Yeah. And like one client, for example, we scanned their personal account and found $60,000 worth of deductions that he was missing out on. And so like you said, it's simple, but it can make a big impact. So those are some things. You can look at some credits that you can take advantage of. And we're not experts in that, but we do have partners that we can refer you to if you do have some areas like energy credits, things like that. So those are the big things. Really just be proactive, make sure your books are caught up. Those are the big things. And then the updates in 2024, I'd say the main one is the BOI reporting. That's where they're just wanting, it's not really an IRS thing. It's just for financial security. They're wanting owners of companies to be able to report their information. And so I actually put together an article that I can share out. There's some really big fines if you don't do that on time. People that have companies that were formed prior to 2024, January 1st, you can get that in, or you have the whole year to get that in. But companies that are formed January 1st and on only have 90 days to get it done for this year. And so that's important. And the fines can be up to $10,000 and sometimes even jail time if you don't do it right. So it's important to file that.
Wow.
Yeah.
Okay.
So, and a lot of tax professionals don't even know about that. So make sure you do the research on that. In the article, I link all the proper the websites that you need to know and go on there to file it properly.
So after this, can you put that in the comment section just so people know what to look for? And then I see we're putting everybody's contact info in the chat section right now. So that way you guys have all their like social media handles and all that stuff.
Yeah, so my sister's actually prettifying the article right now. And so if you, what I'll do is I'll shoot out, I'll put my email in the chat, or I'll put our info email, and people can email me if they want that article, and we'll get that out.
Perfect.
For sure. And then other tax changes, the standard deduction is up to $14,600. So one thing, if you're paying your kids payroll, you can pay your kids up to now $14,600 tax-free. And so there's that, your kids can get raises if they're working for you.
I love that. So do you put them on payroll, or do you 1099 them? Does that matter?
Yeah. So if you have an S corporation, you want to 1099 you and then pay them through you as a sole proprietor, then you don't have to pay payroll taxes. If you have an LLC or a sole proprietor that you're working out of, you can just pay them directly through that.
Awesome.
So W-2. And then other things to look out for is there's going to be changes in 2026. The federal tax bracket max is going to be at 39.6 instead of that 37%. And so just as you're doing tax planning, just think long term rather than just this year. Think out so that we're making sure we're maximizing your deductions over the course of the next 5 to 10 years long term. So
and that's something that'll stay in place for the next 5 years or plus, or how long?
well, yeah, until and the new president's kind of
or 12
whoever's the new,
months.
yeah, so whoever this new president is what matters. So those are the big things.
Okay, good stuff.
Yeah.
Good stuff. Hey, Maconachy, I
So-
love you, but most insurance agents are not being loved right now. So I need to know, dude, with the increase in rates, how can we keep rates down? I think personally, insurance has been more adversely affected the real estate industry than interest rates. Like, I think interest rates are inconsequential compared to what's going on with insurance, because insurance is long term. It increases the cost, and I've seen unbelievable rate increases, especially in some storm prone type of areas. And I'd love to know, what are you advising your clients? You and I have had conversations about this, but please share, how are you advising your clients in order to keep those premiums down and put yourself in a better position from an insurance standpoint?
Yeah. So, you guys who have senior debt on your deals, a lot of the terms are dictated to you by the lender of what you can do, right? So I'm sort of hamstrung a little bit on what we can advise people to do. But we're not totally hamstrung, right? And a lot of the lenders, if you push back on terms, they understand how much stress a lot of the operators are under, and they are willing to negotiate more than I've ever seen before on terms. So,
all right, that's a big takeaway. Talk to your lender and see if they'll be willing to loosen up terms.
Yeah, and a lot of it is like, the lender, of course, wants the A+ Cadillac policy because they want no exposure to insurance being an issue. So it is it's definitely a place where we want to go. I'm not telling you that 100% of lenders are going to back off of terms, but it is something that I'm asking on probably 4 out of 5 deals. We're trying to get some concessions on some tough areas, right? Agreed value is a huge one that it's just it is a requirement of the lender that says, we agree that the replacement cost that you have told us, we agree that that's the right number. Most insurance companies think that operators underinsure their buildings because the property value times a rate equals premium. So it is advantageous to an operator to underinsure their building so that they can save dollars in premium. So that agreed value sticking point, a lot of insurance companies don't want to do it if they don't agree to the value that the operator is coming up with. So that is getting to be more and more difficult, especially with everybody's seen the inflation stuff, and the reconstruction costs have gone through the absolute roof and continue to do so. So there are sticking points there, but I would say attacking terms with your lender is a great place to start. Other than that, the big levers that we get to pull are deductibles. So I've seen some of my operators, they're kind of starting to go against my advice, which makes me think that there's a lot of pain on the financial side of the deal. But you can take a 10% windstorm deductible if your lender will allow you to. I can't believe the lenders allow you to do this, but require some goofy terms that they require, but they'll allow somebody to take a 10% deductible. But I just don't think a lot of people understand what these deductibles look like.
Well, I think it's a math equation, right? At the end of the day, if I can look at and I haven't done this, right? I've kind of, we talked about it on my flood insurance on my own personal home, right? And so on my own personal home, it was $8,500 a year for flood insurance. That was garbage coverage, right? It's a federally mandated coverage. It had a cap of 250 grand, and I had another deductible of another $10,000 on top of it. If that happened. So the premium was $8,500. So I'm like, well, it's going to cost me $20,000, and it doesn't even cover anything. It doesn't cover the pool equipment. It doesn't cover like the storage underneath the house. It doesn't cover my garage doors or anything in the garage. It's like, why do I even have this? A flood would have to like come up 15, 20 feet in order to really do some serious damage to my house. And even then, I got bigger problems, right? And so I got rid of that. And essentially what we did was, okay, well, if you're saving $8,500 by either getting rid of it or increasing your deductible, you don't just take the other money and light it on fire or spend it on stupid stuff, right? You don't. Instead, make improvements to the property or keep it in a reserve. So that way, if you do have some sort of a claim, you have this tranche of capital that you have access to, right?
Yeah, that's a great point. And that is what, as people are increasing their deductibles and saving money, it is the number one suggestion I have is use that to harden your building.
So that's the other one. So first is, if I increase the deductible, let me just kind of like, I'll self-insure this increased cost, right? Maybe I save an extra $10,000 a year on my premium, but my deductible goes up to $100,000 instead of $50,000. So that extra $10,000 I'm going to save for the next 5 years, and I'm just going to kind of put it into almost like an escrow account that I control or whatever. And then that way I can just draw from that if I do have a claim in the future. And at least it's my money as opposed to the insurance companies. The second thing that Drew's saying is you improve your property. So how would you go about improving your property or figuring out how you can reduce the deductible or reduce the premium that way?
Yeah. So, I mean, improving your property, that's sort of on an individual basis, right? You have to see what you have exposure to. The simple ones would obviously be if you have trip, slip, fall hazards, clean that up. But that's on the liability side, which isn't a huge point of pain, right? That the point of pain that we have is property coverage right now. So fixing roofs would be the lowest hanging fruit. The problem is that's really expensive. But if you can tighten up your roof in any way, that's going to help you in the event of a storm. Now, if the storm's bad enough, it's going to rip the roof off anyways. But yeah, reinvest the money, or I like reinvesting the money. I would tell people sit on the money, put it in the bank you're creating a rainy day fund.
Like we have a 36 unit building in Cleveland that we've had for 6 years now. And it's an older housing stock, and it's got older electrical panels. And so on those electrical panels, all of a sudden it was never a problem for the first 5 years. And then the insurance company is like, hey, we don't like these electrical panels. They increased our policy by $20,000. Now it only cost $15,000 to replace all those panels. And so and it wasn't all the panels. It was like one of the sections. And so we replaced those panels, and it cost us 15 grand, but it reduced our premium by $20,000 and improved the property, right? So not only are we ahead financially, but now we have a better property. If and when I go to sell this thing, the buyer sees that there's all updated panels, right? So it's that kind of an understanding and looking at this from an investment standpoint of how do I improve the property, and a simple conversation, just like you go to your lender and ask, can we reduce the requirements on the policy? You go to your insurance company and just say, hey, where are the real risks here? And if these are the risks, the highest to second highest, whatever, and then you can go and get quotes on how do you reduce or eliminate those risks. And then it's a math equation, right? Of just figuring out, does it make sense? It would reduce the premium by this much if I make this improvement, and then you figure it out, right?
Yep. And that, thank you for bringing that up, because insurance underwriters pick on one or two things. And those one or two things change as the industry, but they kind of like, it's almost like they collude together and say, we're all coming together and we're going to attack this problem. The current number one problem that they have identified is old legacy electrical systems. So,
I mean, you could see, because that's what happened to us across multiple properties this year.
Yep. And then once you start stacking, like you've got a couple deals where you stack aluminum wiring on top of being in Louisiana, right? I mean,
yeah, that was a tough one.
yeah, once you start combining issues, right? The insurance world hates Louisiana, hates coastal Texas, hates Florida. So if you are in those spots and then you throw aluminum wiring or Federal Pacific breakers, Zinsco break, there's a handful of no names. If you combine those things together, it can create an unbelievably difficult placement where instead of having 30 insurance companies, when we market a deal, we market to typically 28 to 32 insurance companies. When I'm in a wind prone area that has aluminum, I have two options. So it like
and when there's less competition, guess what happens to prices, you know?
And they know that. They're not stupid. So they're jamming people on pricing. I mean, I've had deals where I've sent out 100% increases and my clients are like, I hate you. You're doing something wrong. They go out, I give them, all the information they need to go do the research with another agent. And I never lose those deals because the market is just really tough. So
yeah.
I love that you brought that up. Thank you for reminding me of that. But as you're buying buildings and as you're, choosing where you're going to spend your dollars, making sure that you have copper and updated panels is copper or Romex, any of the newer wiring systems like post aluminum is a great place to spend money if you're trying to save on insurance.
Got it. Thank you. All right, Scott Hanis, tell me a little bit about the labor market. So we've talked about the tax laws. We've talked about the insurance market. I want to know what's going on in the labor market. What are you seeing? I know that actually Caleb Pearson brought up that the hell's my stat? It's the lowest unemployment. It's like 3.7% is unemployment right now. But what does that mean for the labor market? What does it mean for hiring? What does it mean for maintaining your staff? Like, tell me, how does that as a business owner affect us?
Yeah, so the unemployment rate for December was 3.7. It's extremely low. There's definitely there's a war for talent still. I mean, again, in a lot of areas, a lot of industries. So again, we got to make sure as employers or business owners that we have, the right things put in place. What are our employees or our team members want? How are we retaining that talent? That becomes super important. And again, we got to get creative on how we find people. What's our competitive advantage when we go out to look for hiring somebody? You can't just post an ad on Indeed anymore. You got to do more targeted recruiting, finding out who is going to help you move the needle from point A to point B in your business and not just hire for today, try to hire for the next one or two positions. So always kind of think forward versus, I just fills my gap right now. They added 216,000 jobs in December, which was way more than anybody thought. And so, there's different sectors I think that are doing better than others. And so I think it's really dependent upon your business or the industry that you're in. But I think, again, in order to maintain a competitive advantage, you have to know what that is. You got to be sharing the stuff on social media. You don't have a social media presence, work with Legacy Digital, get that stuff out there, tell people about your brand and what you stand for and your values. And, that is going to attract talent to you versus just waiting for someone to apply to a job that you've got posted. So that's part of it. And then make sure, again, you're doing your due diligence when you hire somebody, just like you would if you're buying real estate or buying a company.
Yep. I love all that. Right. And I think the couple of takeaways that I heard is like, build your personal brand. It's how do you differentiate yourself on a faceless, cultureless job posting that has no personality whatsoever against the other one that's right next to it, right? It's very hard to do. We've attracted unbelievable talent because we create social media content, because people understand who we are, what we stand for, what our core values are, how we do business, the type of business stuff that we do, right? And it makes it very well known. And do you think more people are going to, do you think you're going to make more money and attract better talent to your business if more people know who you are or less people know who you are?
Oh, definitely more people. I mean, and,
Right?
and you see it every day. And again, like when you're doing the personal branding stuff, whether it's content on business, but people also want to know who you are, right? If they're going to work for you as the owner, Like, you got to be a good person. And if you're posting, quite frankly, stupid things about doing things that you shouldn't be doing on social media, you're going to attract those type of people. But if you're talking about how you're helping people and how you want to give back, and this is how you're growing your business, and you're very, vibrant, people are attracted to that positive energy, right? So again, you could do Facebook lives or Instagram lives or whatever kind of things to get, your personality across that may not come through in a normal post, if it's just written text.
Yep, I agree 100%. The other thing that you mentioned was due diligence, right? The same way that you're going to do due diligence on a property or on a business that you're going to buy, you got to screen your employees, right? To me, there's always 3 steps to being a good leader in an organization and a manager, an operator of a business, and attracting and retaining talent. That's one is screening your potential employees. Same way you'd screen a tenant, same way you'd screen a property. You got to screen in order to make sure you do a background check, make sure you do a financial background check or a credit check, right? Especially if they're going to be doing money type stuff. And then secondly, you got to train them properly, right? I would, hey, who's dumb enough to come work for me early on, right? And I'd wait for anybody to raise their hand, and then I'd give them a job, and then I wouldn't train them. I'd expect them to know everything that I did. And then the third thing is I wouldn't measure their performance. And you wonder why I had to fire everybody twice, early on in my business. I had to eliminate, and I was like, oh, it's got to be them, right? And it wasn't. It was my fault. And now I've learned we screen everybody before they come and work with us. We train them and spend a lot of time training them. And then we measure performance based on metrics, key performance indicators, and SMART goals that are quantifiable. So that way they know how they're performing. We know how they're performing, takes the emotion out of it and makes it all data driven, right?
Preach, brother. That was great. Everybody listen to what Tim just said. That's exactly what I would say. Yeah.
Hey,
and then the other thing
I
is,
say it because I've heard it from you enough times.
well, and I think the big thing is like people either live up or live down to expectations. That's a Scott Hanis phrase. You can
I
take
should
it.
have used that one.
But if you do not give them the clear expectations and the communication, again, to your point, look in the mirror, it's on you, right? And again, there's those unset expectations. I want them to go do X, Y, and Z. And Tim, we've talked about this several times. But if I want something done, and if I don't give them a clear deadline, I want it done by 4:00 today because I have a meeting at 5, then it's on me for the unset expectation. They just think that it's got to get done at some point, maybe in that day or in the next day. So again, we got to be very intentional with the words that we use and our actions as well.
Yep. Great insight, man. All right. So what I'd like to do is a lightning round of what is the number one piece of advice, thing to look out for, takeaway that you want people to leave here with based on your expertise and your industry. So I'm going to start with Melanie, then Drew, then Scott. What's the number one thing for 2024 somebody can be doing, or best piece of advice that you can leave them with?
Yeah. I also forgot to talk about bonus depreciation is now to 60%. So I put that in the chat, but I wanted to make sure to note that it's going to be phased out by 2027. So just know that it's winding down. The number one thing is to be, I mean, have a clean set of books, get your books caught up, and then work with a tax professional that's being proactive for you so that you don't have to, do that, basically make sure your tax professional has your back. That's the biggest thing. And do tax planning throughout the year. Know that you're checking all the boxes so that you don't miss anything.
Love that. And I think, from a standpoint of bookkeeping, do you like third-party bookkeepers, in-house bookkeepers?
I think it depends on the
any
business.
Bookkeeper is better than no bookkeeper.
Yeah, as long as it's getting done, I think it depends on the business. If you have a lot of activity, then an in-house bookkeeper is nice because then you know that it's being updated regularly. But I mean, we do third party. We do our clients' bookkeeping for people that just need that
I didn't
extra
know you guys did that.
handholding. Yeah, we do have bookkeeping if needed. But there are some people that need an in-house bookkeeper, and we really aren't the best solution. So it just depends.
Well, it's a math equation, right? Like I started out with a fractional bookkeeper, similar to what your service is, I would think.
Yeah.
And they keep my books once a month, and then once a week, and then it was twice a week. And then when I got to 3 times a week, it made sense to just bring it in house and have somebody full time as opposed to paying these other rates, right? And so where are you in business? Weigh out that, get a quote from a fractional bookkeeper versus Scott Hanis can find you a bookkeeper, right? And then you eventually scale to that. So That's great. And I find that the good CPA firms will kind of train the bookkeeper on a couple things to pay attention to. So that way it makes your CPA's job and billable hours less, right? And easier.
Yeah.
So, yeah, that's great. Great takeaway. I agree 100%. I think a good bookkeeper is worth their weight in gold. So,
Yeah, for sure.
awesome. Appreciate you. Drew, how about you, brother?
Competition. I mean, in one word, you need to make sure that your agent is doing their job and not just renewing the deal that you have, right? They must be sweeping the market for you to make sure that every insurance company that may have an inkling of interest in your deal is getting a look at it. Now, I'm not telling you that. All right, good.
I was going to say, how do you do that? How do you ensure that they're doing that other than them saying, oh yeah, I shopped it around. This is the best thing.
So when they send you a quote, say, send me the list of insurance companies that you approached and what results of that. And if they can't do that within a day, like, you're going to have a pretty good idea that
they didn't do it,
that they just renewed your deal for you. So it's a very easy check and balance on your agent to make sure their job. I'm not telling you at all that you're going to leave your insurance company every year and go to a different insurance company. If it was the best deal last year, in all likelihood, it's the best deal this year, unless they got, unless that insurance company lost their ass.
Yeah, good point.
It's likely going to continue to be the best deal, but you pay me to make sure that I'm getting you the best deal. That is I'm not a fiduciary, but I feel like it, right? I feel like I have to make sure I'm getting you the best deal. So I think that's a very simple ask and a very reasonable ask of your, make sure that they're doing their job. Now, if they are a captive agent, if you use State Farm or AmFam, those are the two probably biggies that people know of. They can't get you different quotes, so you just kind of have to roll with them. And if you think they're not doing, if their rates are going up, you need to go find an independent agent too. I would suggest you get an independent agent anyways. Somebody that, like me, that has access to 32 markets, and just pit me against them, right? Say, I like my AmFam guy. He's great. I know he only has access to AmFam. Please quote against this. And then whole thing covered.
Yeah, I agree 100%. And I think those are fantastic takeaways, man. I think just make sure that you're out there, make sure that you're, asking every single year. If you don't ask, you don't know what the solution could be. So you got to be proactive, especially in this market.
Yep.
Good stuff, bro. Appreciate you. Hey, and by the way, guys, as I'm thinking about this, I was sending a message to the team. Pretty much, I think everybody on this that has been a speaker has created a course in Legacy Wealth Academy. It's like our library. We have a digital library of these master classes taught by experts in their corresponding industry. I just texted the team, and I want them to give you a free month of that. It's only $10 a month anyways, but I'm going to give everybody who's registered for this a free month. So that way, if you want to go back and watch Scott Hanis's masterclass or Melanie Sikma's masterclass or Drew Maconachy's masterclass on insurance, and everybody on the financing side, I think, has done a course also. And I think Caleb did a course. So like, we have a lot of courses in there on all these different expertises. You guys can have a free month of it. If you don't get through all of them, it's only $10 a month thereafter, but we'll send you a link for a free month of Legacy Wealth Academy, just so that way you can lean into all the expertise that's been on this call. All right. Little New Year's gift to you. So Scott Hanis, bring us home, buddy.
Yeah, I mean, so we talked about war for talent. We talked about unemployment at 3.7%. My big thing for you to take away is invest in your people, invest in your team, give them the time they deserve. Make sure you're holding them accountable. Make sure you're treating them well. Do monthly check-ins with them to make sure that, again, even if they're a high performer, give them time, right? They work for you, right? So make sure that they feel appreciated and welcomed and respected. And so that's really important, especially with retention. With unemployment at 3.7, there is a war for talent. So people are going to be trying to poach your talent. So what are you doing to safeguard your house? So make sure, again, you're taking care of your team, you're investing in your people, and you treat them well.
You know what I love about that is that you said invest in your people. And part of that is probably the monetary and economic side. But another part is, what is the goodwill? Like, what is the culture that you're creating? What is the values that you're following? What is the team culture and having fun, right? And that carries just as much, if not more weight than just a raise, right? A raise is some, meaningless
Monetary.
number on a piece of
Yep.
paper, right? Where, I don't know, I'll give you an example. One of my team members came to me and they wanted a weekend up at the mountain house at the lodge. That's not even booked in February. It doesn't make a big impact on me, other than, I'll pay for the cleaning fee, and she'll be able to go up there with her friends, with her family, and enjoy a 12,000 square foot, unbelievable estate with the people that she loves, create amazing memories. And that's a pretty cool advantage of the job, right? That we don't really market or anything, but it's a cool thing to have, So I think being able to do stuff for the team makes me feel good. It's an added bonus to being part of the organization for the team members too. And you don't always have to think about increasing your overhead and tightening up, the constraints on your business and financials on your business, which is, I think, what a lot of people think of when they think about building out a team and investing in talent. I think there's other ways outside the box to attract great people to your organization and retain great people to your organization. So those are fantastic takeaways. So I appreciate you guys. Thank you so much for being here. I know Drew had to drop off because he had a meeting at 12. Drew, thank you. Scott, thank you. Melanie, thank you. Guys, make sure that you're connected with them. We put their contact information in the box there. And now I'm bringing up my boy, Mr. Mark Evans. So Mark and I have known Mark for about 10 years this year. I've known Mark, and I was selling a portfolio, trying to wholesale a portfolio of properties on Craigslist 10 years ago. He inquired on it. I was too stubborn. He was too cheap, I think, to buy it. And then eventually the deal morphed and we ended up joint venturing. He invited me out to my first mastermind that I ever attended and completely changed the trajectory of businesses forever once I understood the concept of surrounding myself with great business minds, great business mentors, good people going in the same direction that you're going, and all the exciting stuff. So Mark always brings a ton of fire and a ton of excitement. And Mr. Evans, bro, I'm excited to have you here, man. Thank you for being here.
Definitely, man. Thanks for having me. I've been watching, man. This is awesome. Each person paid at least 10 grand a piece to be here, I hope. Dude, it's not paying attention,
It's been so much value and it's gone really quickly, but I hope people take notes because there's so much good takeaways. Every single one of the people have dropped a nugget that would save at least $10,000 to somebody watching. So either save that or make that much more money this year. So all right, brother. Let's dive in. You have multiple businesses, all doing 7, 8 figures. Some are on the brink of 9 figures and doing amazing things. A huge leader in the business realm, come from the real estate realm, and I've had a ton of success across multiple variant businesses, right? And so let's talk about, what are you seeing? What are you excited for in 2024 as we get into this new year? Like, kind of what are your projections? What are your thoughts? What's kind of getting you riled up?
Listen, I wrote a book about this in 2-3 years ago called Maconachy. I'm excited every year, no matter what's going on. I don't care. Trump's saying something to Biden, or Biden's definitely saying something about Trump. I don't care. It doesn't affect me in any way, shape, or form. What it really does is sorts out the community of who I want to hang out with and who I don't, based off their stupid remarks. And like Scott was talking about, how you're posting, what you're posting on. Don't think that, the beautiful thing I'm focused on is, just constantly building my social brand, staying in front of people, dropping massive amounts of value. Like Gary Vaynerchuk always talk, give, and extract. And, when the time's right, and we don't know when that time is, we're all in different places. But if you focus on yourself, unfortunately, I think a lot of people are desensitized to reality. I think they all think everyone's living this amazing life, doing nothing and getting rich, and it's easy. I do have a lot of cool successes, but I got a lot of shitty problems too. We all do. And the thing is, Tim, you and I talk about this behind the scenes, dude. This is the beautiful thing about real entrepreneurship, that we sit back and real entrepreneurs ask well, why isn't everyone doing this? Why isn't? And then some people are like, so easy. Why does everyone do it? Well, these are times when you get hit in the face and you get back up, you smile, this really comes down to mindset and compartmentalization. Can't even say the word. Compartmentalizing the problem, because you got your team, you got family, you got more problems, you got a lawsuit, you got, financing, you got to borrow money. Like there's all these things going on. And it's really about mindset and controlling your emotions in all times. And this is the me economy effect. It's like, if you control the controllables, control you, everything else will work out. Just keep your feet moving. People get too overwhelmed, too frustrated. They can't take a loss. If they take a loss, the loss controls them. Listen, we all have losses. Anybody says they don't, absolutely run, because there's losses in this game. It's not like Tom Brady's won Super Bowls by not losing. It's not, but the difference is we don't let losses define us. They sting, they hurt. We learn from them. We see where we messed up, where we can win, and you figure it out. But dude, I'm excited every day, honestly. Like I get to wake up. I was at the gym today. I don't want to be there. I have to be there. There's people that literally, one of my friends, their friend is like getting ready to die. She's 36 years old. She can't move. She has this weird disease, and like she's literally on her deathbed. She wishes she could go to the gym. Well, everyone here is like, "Oh, dude, it's so hard." Good. Who said it was easy? Get your ass up and get to work. And I think this is like, that's going to be my biggest message in 24 is just get your ass to work. Just do the work, and everything you've dreamt about is on the other side of work. I promise you that.
Dude, I so much good takeaways there, man. And I think going back to the wins and losses thing, people, they get in business, they think they're going to win on every single deal. You don't win on every single deal, right? Like you're going to do 10 deals, you're going to lose on 2 of them, but hopefully you win on 8, right? It doesn't matter what sport you play, what competition is out there. There's W's and there's L's. And anybody who's been in business long enough where, guess what, dude, I've lost money on deals. And I've gone to my investors and said, hey, we got our ass kicked on this thing. And I haven't been able to pay you X number of return, but I'm going to give you some equity over here on the next deal in order to make up for it, right? And I'm able to do that because and the business owners who get it, who've been in business, are like, dude, totally get it, man. We've won on all these other ones. Let's keep moving the ball forward. Like, just keep it moving it down the field, and we know that we're going to score a touchdown, right? And so. And that's the way it works, right? There's going to be a L, there's going to be a loss, but do not focus on that. Do not let it paralyze you from continuously moving the ball again down the field and moving the ranks over and over and over again. I think that's so critical, and doing the work, right? Like as you know, man, last year was probably the most difficult business year of my life, and we had this huge deal go sideways. I was supposed to be passive on. I had to step into an active role. We totally tabled all acquisitions in order to move my my operations team to the site, turn this whole thing around, infused over $10 million in order to save this deal from going back to the bank. And most people would not do that. Most people would give it back to the bank. Many have. And I didn't want to do that, right? So we worked our tail off. It's been super stressful, super difficult. And it's like, how do you turn around that size deal? Well, you do the work, dude. How do you eat an elephant? One bite at a time. And you figure out what activity, what action will make the most impact right now. And then once that problem is solved, then you look at the next biggest problem. Then you solve that one, and the next one. And instead of looking at it like this paralyzing landscape that's going to just, you can't think, it's what's the biggest problem to be solved right now, and let's solve that one, and then we'll move on to the next one. And doing the work, rolling up your sleeves, and then going out there and actually doing it. Yeah. We've been living in this world of people who don't want to do the work, of everybody who wants to set it up and forget it, the 4-hour work week and all these different ideas. Like, I know Tim Ferriss, he's working harder than he ever has right now, and he's working a lot more than 4 hours a week. And staying busy on a lot of things that he's doing, right? And so the entrepreneurs that get it, yeah, hey, there's a season where maybe you can just kind of sit back and kick your feet up a little bit. But when opportunities are shifting, and when things get a little bit tougher, or things go sideways, or they're just not more difficult, just different, right? You got to be willing to pivot and able to pivot. And so I think that's a key factor. And then the other thing that I would end with is, or that I want to take away from what you said, was the me economy, right? You don't care about that economy. You don't care about this economy. You don't care about any external factors. You care about the controllables that you can control. And you've always done a fantastic job of that, and controlling the narrative of it as well, right? Of understanding people are going to be influenced right? Are you a thermometer or are you a thermostat? Are you the one setting the temperature, or are you the one being influenced by external factors and just reading what's happening in that, right? Are you proactive or are you reactive? Are you a leader or are you a follower? And you've always done a great job of being a leader and setting the temperature, setting the tone, indicating where things are going, as opposed to just reacting to media and news outlets and the sky is falling type of commentary.
Yeah. I think that's big. And, everything you're saying is point on. If you guys are in this game, like you said, Tim, we've been together 10 years now. Pretty much a lot of people in my ecosystem's been around a long time. There's a reason, right? Like, to us, guys like us, relationship is the ultimate currency. That it really is the ultimate currency. And if you really understand that and you truly do that, and you have to have tough conversations. You have to have real conversations, I should say. Not even tough, just real. If you have your friend that's getting out of line, you got to set them straight. You got to say something, and not to be a douchey way, but like a respectful way. Like, yo, you're my boy. Like, check them. Like, me and my buddies been walking around. I see a lot of people divorcing and all this stuff. It's almost like it's an easy button. You got kids, in fact, like these like this stuff I see in business. I'm talking business divorces, relationship. Like, I get it. Sometimes it happens. It's part of the game. But like, some people aren't fighting for it anymore. You got to fight, and that's what you're doing, Tim. You're fighting. And the thing is this is where the growth happens, is in the fight. We all hear these cool memes. The bigger the problem, the more the money I make. Well, too many of you not solving real problems. You're like, your problem is like, how do I make 3 calls a day? That ain't a fucking problem. There's no problem there. That's you being a wimp, not making a phone call. That's not a problem. The real problem is when you're down at the title company and you're getting ready to close that deal, the private money didn't come in like you expected. 11th hour, you got to close this deal. And the next day, if not, your money goes hard and you're out all your escrow, blah, 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 blah. Like, that's when you grow. We're not praying for that. We don't want that to happen, but it's going to happen. Part of the game. So it's like, what do you want to do when that happens? That's what you better be prepared for. And not only that, I want to recognize everyone that's an operator in the business, because a lot of people, I'm more of a visionary. I'm not a day-to-day operator, right? So like, I'm more of a visionary, and I think everyone's like that, but that's not the case. Like, if I have great vision with no operators, I'm broke. Like, I got to be a great communicator, hook up with good people, let them do great work together, and like, just cast vision. My job is to cast visions at this point in my life. Almost 28 years in the game. June 2nd, cast visions. Send me the real big problems. The truth is, I only hear the real big problems. Like, oh shit, we're getting in trouble. Here's the deal. Like, okay, now we need to solve it. Right. But you build a great team. And I know, Tim, like, there's a lot of great operators here, and you guys don't get enough credit. And don't think you need to be me. Don't think you need to be someone else. Just be the best you that you're driving. I know an operator that is worth a lot of money, and he loves to operate, and he'll never be the visionary. He has good vision, but he doesn't have long-term, like, he doesn't have like deep vision. Like, he sees where he's at, but he doesn't know where he's going. That's why you need guys like Tim. That's why you need people in your corner that can see it's already been there. Like, hey, here, just a heads up, this is coming. And they're giving you, they're letting you adjust accordingly. So, props to the operators. This year, I'm spending a lot of time with my operators on my teams and really like forging, because I have amazing operators, man. And I'm very honored to have them in my corner for sure.
Dude, and that's the key. You don't have to be Superman. You don't have to be Wonder Woman. You don't have to be this Renaissance person who can do everything. You need to understand what you're really good at, what your superpowers are, and then you need to complement that with somebody who has different superpowers. And then 1 + 1 doesn't equal 2. 1 + 1 = 11 in that scenario. And you can do more together than either of you could independently and on your own, right? And so making sure that you're figuring out, what is your behavioral type, right? Some of us are operators, some of us are visionaries. Some of us can blend. And that doesn't mean that you're not supposed to, or you're not able to do the other things. It's not your natural skill set. It's not your natural environment of what you do on a daily basis. It's a little bit more of a stretch for you to get into the trenches, but I still get in the trenches, right? And I can do that. It's just, I'm more empowered when I'm vision casting and I'm leading the team and I'm doing the higher level stuff. Not higher, just, I mean, like higher level, like thinking and visionary type stuff. But that's not to say that I don't get into the trenches, or I'm not willing to get in the trenches. Like, you and I have been in plenty of trenches and have done the work. And the reason that you can be in the situation and sit in the seat that you're in today is because you shoveled shit for 20+ years and you were in the trenches and you understood how to attract quality talent and bring them into your organization. So
I think the biggest thing is it's like what you guys are all here learning, and it's awesome. Learning is a great, building this repetition of learning and all that's awesome. The truth is a lot of this is like internal work. I call it thought auditing. You're going to have to unlearn, kind of like when you're reprogramming your computer, you got to take off the old hard drive and put a new one in. The thing is in real business, collaboration is the ultimate currency in the game. You have to collaborate. In school, when I got caught collaborating, they put me in detention and called it cheating. Like I was really good at math, really bad at English. So still am. But like the thing is in real life, real business, collaboration. I need them. They need me. I need other people. Like this is a collaborative game. So if you're trying to do everything, you're actually suffocating your genius inside of you. You don't even know it. And by the way, it's okay. In the beginning, that's kind of what you got to do because you're still trying to discover. But knowing what I know now, it's like I was a D student. So I wasn't even a C, so I was a D. I just like, give me a 1.8, get me out of class. But like, that's because I wanted to go pursue growth. I wanted to work with other people. I knew what I was good at. I knew what I sucked at. But like, I didn't understand how to collaborate. I was micromanager. I didn't have good systems and operate. I didn't understand all that. I just was brute force, hard work. But as you get bigger in the game, like start understanding you need a good title company. You need a good operations manager. You need a good property manager. You need all these pieces and you need to start creating these people. Tim, that's what you've done. You've done this for them. So like you can literally meet a lot of these, if not all of them, these independent people inside this environment, but meeting them and getting to know them are two drastically different things. It's not like, oh, I know that person. It's like, no, I really know that person. I roll with them. Here's what I'm doing. Here's how they roll. Here's how I roll. And we're winning together. So win with winners, dude.
100%, man. 100%. Talk a little bit about what your goals, ambitions, where you're seeing opportunities for 2024. I think what you're doing is really, really cool. It's a really exciting. And we were talking offline about how much focus it creates of like this laser. You don't hear any noise because you're so focused on your goal of building a $10 million company inside the next 12 months from scratch, essentially, either buying something or starting something from anew and scaling it up to essentially 10 times whatever it could be, and putting another $10 million of liquid cash in your bank account on top of $10 million in equity, $10 million in cash. Talk about that. Talk about how you're going to do that. Talk about, I mean, if you're not following Mark, you need to be following Mark because he's sharing every step of the story along the way. So make sure you're watching this because it's really inspiring and really cool to see.
Yeah, come watch me fail. It's going to be fun. But listen, my goals, I watch everyone talk about after the fact, that like what I did, not what I'm doing. Right. So it's easy to share what you did. And honestly, the truth is we do so much, I forget what I even did. I'm just doing. So the thing is I was like thinking about in 23 towards the end, I'm like, I want to share a journey. Can I turn $1 million into $10 million? I know how to make money. I'm not saying that cocky. I just know how to make money. That doesn't mean you can not all money's created equal. Like passive income's different, active income's different, equity income's different. Like there's a lot of different ways of income. But at the end of the day, for me, it's like I have, and this is on top of everything I'm else doing. So it's like every deal I'm looking in this pod, 1 million to 10 million, has to meet a certain criteria. If not, I can't get to the 10 million. I have to 10x this money through effort, through conversations, through relationships. People are like, yo, man, I have an investment, I have a business, I have this or what, and I'm going to come in with equity. I'm going to come in with knowledge. I'm going to come in with, capital relationships and put all these pieces together. And I'm going to put a lot of pressure on me to expose hey, here's what I'm going to do. What if I go from 1 million to 10 million? What if I go 1 million to 3 million? What if I go 1 million to 20 million? I don't know because it's real time. I'm going to share the real time journey. I've never seen anybody do it, so it's kind of like I would watch this. I would read this newsletter. It's a once a week thing. It's going to be a newsletter. There's nothing to buy. No credit. It's not like that. It's more like I want to share stuff that's working. And most importantly, I want to share with you my losses because there will be losses in aggressive growth strategies like this. Point blank, there will be losses. The question is, how do you deal with it? What'd you think about? What'd you do next? Because a lot of people, when they take the L's, they take it as a loss and it's over. I take it as a lesson and learn from it and move forward. Because I can't, like the loss will own you until you let go of it and go win. So it's like you keep losing. It's almost like some people are addicted to losing. Like, yeah, man, you don't understand. It's really tough. There's still people in real estate talking about 2008 and 10 crash. It's like, dude, fuck, it's 2024, homie. Let's get over it. Let's move on. But we have to push this forward. And I'm going to just share once a week. sending you a newsletter, breaking down the deal flows. If I did a deal that week or not, that fits in this bucket. I'm doing deals every week, but like a deal that fits in this bucket. And I'll share some insights about how it got created, how much I brought to the table, what my expectations are, what my risk factor is. Like I'm gonna have a grading scale on this thing for you guys. Like I'm gonna share with you, time scale, risk scale, like a bunch of different factors that you guys need to think about. Because I don't think a lot of people think about like, yeah, I can buy this business. Oh, but I don't want to work 12 hours a day. I can buy this business, but I gotta be in the office 18 hours a day. Well, I'm not into that. I don't go to offices. I have awesome offices. I just don't go. It's not where I shine. I don't like distractions like that. But I have teams there and they love it. Right. So I know what I'm good at. I know what I'm weak at. And I'm looking for strategic people and partnerships and opportunities to accomplish that goal, Tim. You've done this before, so you know how it works, man. It really is a laser focused action step.
Yeah, mine was $1 million in 1 month during COVID, when COVID hit. And we did $1 million in equity, and we did $1 million in actual cash. There was about 1.25 of each, or somewhere around there. But it's amazing how it compounds, dude. Just like putting your head down. I think you're probably going to build a $30 million company because you got your head down and you know exactly what the multiplier is going to be. You're not looking for an addition type of a business. You're looking for an exponential growth type of a business. Putting more eyeballs out there creates more deal flow of people sending you opportunities, creates more people knocking on your door saying, can I invest, or can I be involved? Can I come and work for you? Can I be one of your operating partners? Can I, like, all of that stuff, man, is just super exciting. And I can't wait to see what that looks like over the course of 12 months. So,
well, yeah, I mean, dude, it's already happening. It's already happening a little bit, right? I started talking about it. And then for me, the truth is, it's not a spoiler alert, but I already have done 2 deals already. And it's, the 5th, right? So I've already done 2 deals. One of them just got inked up yesterday. The other one got inked up 2 days ago. But the one deal, I believe that one deal alone could, like you said, be worth 20, 30. I mean, potentially, right? It might go to 0. Maybe the partner says, F you, I'm out, whatever. Like, who knows? But that's what makes it interesting. I think it's like, you guys have to see what real business deal making looks like. I think you guys think this magical world where it's like, I'm going to find this amazing deal. It's going to fall from the sky. These investors are going to give me all this money, and it's going to be simple, and I'm just going to buy it. And it's going to work out perfect. It will never, ever, ever, ever work out like that. Because perfect it's relative at all levels. So it's going to be neat, man. I think it's going to be awesome, Tim. I'm excited for it, man.
I'm excited for you, man. So as we wind down, I know we're going a couple minutes over, guys. What I'd love to do is have Mark give you one final piece of advice for like what's going to move the needle the most in 2024. That's going to be the question I'm going to ask you, of where the biggest opportunities are, best piece of advice, biggest takeaway, biggest thing to implement, anything along those lines, Mark. And then after that, I'm getting a couple messages about our mastermind, Legacy Family. So I'll stick around for a little bit afterwards, share a little bit about that mastermind for anybody who wants to stick around. They're looking for a community. Happy to chat with you guys about it. And answer any sort of questions. So Mark, let's rock and roll, man. Tell me what the number one thing, what can somebody focus on right in 2024 to make it their best year yet?
The biggest needle mover is you as the person, looking at you and seeing how you move. I call it thought auditing. What makes you move? What slows you down? What past bullshit are you trying to carry forward like a weight? Let go of it. It's the past. Leave it alone. It doesn't serve you. Too many of you are sitting there letting the past control your next step, control your future. Oh, I had a bad deal with this person, so every person's bad. No, dude, listen, it was just a bad situation. You were a totally different person, totally different time. You're better than that. You're showing up to these types of events. You're investing in yourself. You are the best investment. I know you guys, it's too shit. Like, it's the truth. It is the ultimate truth. You guys will go spend 150 grand at fucking college, but you won't spend 25 grand on yourself in a community that can make you millions of dollars. It's mind boggling to me, but I can spend 150 and make 50 grand a year. Sounds like a good investment. Not saying there's not cool relationship things, fun, silly stuff you learn there, but you have to step it up. You cannot go on in 2024 and beyond as the old person. It's not going to serve you. It's not going to get you where, and you don't need to be crazy over the top like me or like, I'm actually a pretty calm guy, but like I am a killer inside. I've invested millions of dollars in myself. No one's going to invest in you if you don't invest in you. Why would they? So if you're talking to Tim like, yo, how do I raise money? Well, are you investing in yourself? No, but I'm going to. Well, when you do, I'll invest in you. But until then, like there's a disconnect to the universe. This is what the problem is. Like everyone wants everything given to them, not work for it. But you got to work on you. I think 2024 should be the year everyone really goes deep in themselves, because there's going to be, by the way, there's a shitstorm in the making, by the way, in 2024, just with the election system. I mean, it's going to be, stay focused. Don't get distracted. Focus on you and your family and your future, because whoever's president, whatever happens, 2025 is still going to come. 2026 is going to come. You're either going to be better off or worse off. But I would say get real serious about yourself and get real serious about your skill sets and execute accordingly.
Dude, 100%. Like the greatest ROI isn't this asset or that asset. It's, dude, this, your own insights, your own relationships, right? And I mean, you said it. You said relationship capital is the ultimate currency. So who are you surrounding yourself with? We were talking about this before, Mark, over the summer, I think, and we were talking about, we did that Facebook Live, I think, in June over here on your birthday, and I had just seen a study and a report that came out and said, how do you change your luck, right? How do you change your luck, and what's the driving force to change your luck? And they interviewed tens of thousands of people. They did all this stuff and all this research, and they came down to one thing. And we thought it might be your choices, but you know what influences your choices even more? Who you're hanging around with, where the influence is coming from. And by changing your network, by changing the circle of influence and who you're hanging around with, that is how you change your luck, is what this study came down to be. And like, think about the insights that we got in the past 120 minutes just from this. And imagine as things go sideways or as things change and all this other stuff, making sure you're around the right group. So guys, make sure that you're registered for all the future trainings that we're having for free on every Friday for at least the next 2 months. There's a couple that I have to miss because I'm traveling and stuff, but otherwise 10 a.m. to 12 noon every Friday, we're doing some sort of a training to help level you up and give you those insights. And Mark, dude, I know that you've set aside $1 million to building your personal brand this year and investing in yourself, right? I don't know how much you invest in masterminds, but I think it's close to that too. It's at least $500,000 a year that you're investing in yourself, in relationships, into connections, into masterminds, into networks, putting yourself in the right rooms, and deepening relationships with existing people already in your network, like me and many of the guys in the DM fam and stuff. So, dude, it's cool to see what you're doing. It's awesome that you're leading by example. It's awesome that you're inspiring and paving the road, right, for everybody else and making the path easier for them. That doesn't mean they don't have to do anything, right? Like, invest in yourself, make sure that you're in the right rooms, make sure that you're doing the activities, right, that drive the results that you're looking for.
Yeah, I mean, real quick to your point, because I know we got to go, but like, listen, you guys, most of you guys have kids here, right? If your kids are hanging out with drug addicts all day, what do? You let them do it? Of course not. That'd be fucking stupid. So stop being a dummy and hanging out with dipshits and get into a room. And if you don't have a room, build the room. Get together with people. Post online for free. Hey guys, we're doing a meetup. We're going to talk about business. We're going to talk about money. We're going to talk about life. We're not going to gossip. We're not going to talk about vacations. We're not going to talk about silly shit. We're going to talk about winning the game of life. Be the leader of your leaders. Don't be my leader. Be your leader. Tim leads me. I lead Tim. We lead together. The harder we lead together, we see the ripple effects. So it's like, why would you but again, what's interesting too is like, you have kids that play sports. That's awesome. And you invest in coaches. You'll invest in travel to take them to these things, but you won't invest in yourself. Why? Until you invest in yourself, I'm telling you, it unlocks another level you don't even know exists. When people invest 50 grand with me, they think they're doing it for me. They think they're doing it for knowledge. No, all it is they're doing it for themselves. It takes it's a muscle. You got to get used to it.
In a good way, right? Like, I remember when you asked me to join your mastermind, right? 8-9 years ago, whatever it was. It's been 9 years now. I remember being like, it's a lot of money, right? But as soon as I invested it wasn't for you. It was for myself. And dude, it gave me this level of confidence where I'd puff out my chest and I'd show up differently. I showed up because I knew that I was worth it, right? That's the differentiator, really. It's like the mental muscle of, are you worth it? It's not whether or not I can get value from this mastermind. Like, there's enough testimonials out there and all this other stuff. But it's like, do I believe in myself enough to invest in myself that I know that I can take this information, these insights to the next level? That's really the bigger question. And it's chicken or egg situation. Do you wait until you have the confidence and then you do it? For me, it was blind faith, and then it helped build by doing the activity, I gained the confidence. And so,
100%.
And I've seen it go both ways, but good stuff, man. Well, dude, I appreciate you. I appreciate you so much from a friendship standpoint, from a business standpoint. You know, this past year, 2023, again, was a very, very difficult year in business. And without networks and mentors and, you know, people in my corner like you, man, I wouldn't have been able to make it through it. So really appreciate you. Thank you so much for all you've done for not just me, but your entire community, my entire community. And I'm excited to watch the journey over the course of the next 12 months.
Amazing, man. We're just getting started. I appreciate you, Tim. Keep kicking
All
butt.
right.
Appreciate you
All right,
guys.
brother.
Thank you.
Appreciate you. All right, guys. Well, that concludes the discussion panels and everything else that we've got going on from a standpoint of trainings and the state of the market. And so hopefully you guys took a ton of notes. This is live on Facebook, so you can always go back and rewatch this after the fact and go through and take some more notes and some of the big takeaways from all the different people on there. Make sure you guys are following each of the contributors that shared their state of the market updates. They're all phenomenal human beings, great business people, but even better humans. You know, they are dear, dear friends of mine and have become dear friends through the business side of things. And so really real rock stars and great network for you to surround yourself with. And to Mark's point, make sure you're right in the right community, whether that's a local community. Like I got started my own meetup.com in Cleveland, Ohio with a bunch of entrepreneurs in order to just kind of know people in the local marketplace. And then I joined masterminds like Mark's and joined other masterminds. I was in 6 masterminds a couple of years ago, and I've kind of refined in order to deliver as much value as I can to my mastermind, which is Legacy Family. But I still participate in Mark's and a couple others on a basis in order to, you know, network with those folks and for some different reasons on that side of things. So make sure you're in the right community. Make sure you're in a community that's going to help you grow. Make sure that when the market's good, it's great to be in a great community like a mastermind, right? And when the market's bad, that's when it's even more important in order to bounce ideas and help get out of mental funks and all those other things. So appreciate you guys being here. Love you guys all. And make sure you're here next Friday. We'll be talking all about acquisitions and underwriting of commercial real estate deals.